All right, so welcoming everyone to this session on an introduction to options. It's going to be perhaps a pretty much eye-opening webinar for some of you. For some of you, it might be a revision. For some of you who might already be trading, it might be back to basics. I'm not sure. I've seen quite a few new faces, new names, at least on the webinar, and there are more along the way. Sunday morning, not sure it's the best or worst time to have it, but anyhow, I at least hope that for at least some of us, this Sunday morning could perhaps be a pretty eye-opening session in terms of what is possible in the markets and the opportunity that is available for anyone who likes to take this seriously. So before I jump in, I'm just going to do a very quick poll so that I have a sense of who the participants are and what your background is, and then I guess I should also introduce myself after that. All right, so just quickly to get off the foot. So how many of you for how many of you is options an absolutely new thing? I mean, options, financial options. How many of you it is something new? All right, Prakash. Just everybody, put it in the chat box quickly and have a response. All right. So we have two Prakashes. What about the others? Especially the new guys. All right. So how many of you have you traded options uh, in the financial market, in the Indian stock market? You have traded and done at least a few trades. All right. Let's have the responses. Yes, Ganesh, of course you have. Vijay, all right. All right. Anyone else? Madhu has. All right. How many of you have um, knowledge and practice either technical or fundamental analysis or both? How many of you know TA or FA or both? None. All right. Okay, Yunus. Madhu knows both. Yes. Anyone else? What about Umesh and Vijay? All right. So, question for Vijay: have you used your FA analysis to do an options trade? All right. So, all right. All right. For those of you who have traded options, or some of you have, how many would say that you've done it on the basis of a sound analysis of whatever trade you took versus you sort of maybe did some analysis and then just took a shot? I mean, for how many of you was it based on something really well grounded, and for how many of you was it something which was like, okay, let's give it a shot? Okay. uh, the anonymity of a webinar is that you can say anything and you don't have to feel embarrassed. All right. All right. Okay. So let me just share with you what I propose to do, and I would really like this to be a useful couple of hours. And therefore, I would also like to know if there's anything specific that you would like covered. And if that is the case, then, please feel free to open up your mics, put the question or query across, or if you're more comfortable, you can put it in the chat box. So what I would like to do is a few things. One is basically go over what options are from a conceptual point of view, and that should definitely be useful for those folks for whom it is completely new. Then, and of course, for those of you who've traded, it probably will be a bit of a revision. And then I want to also talk about um, what the opportunity is, and I hope to show that with some live examples that have happened in the last couple of days or 1 week, and maybe there is something that could be there in the in the coming week, and perhaps if that is there, then you could look at that and at least track it. And then I would also like to talk about what it takes to sort of put it all together and take this up seriously. As many of you who know me know, right? As many of you who know me know that I really like to I at least it's my preferred approach to look at things deeply and at a much more grounded level, and to demonstrate and to understand what the big picture is, because I really very strongly feel that most of us, I don't know everybody on today's webinar, but most of us are completely even for people who are aware of what the options are, I don't know how many of us are really taking advantage of the opportunity. And what drives me is that if one were to take advantage of the opportunity, then what does it make possible in each of our lives? Some of you know I speak about this very passionately. For some of you, it might be very new and very um, novel and maybe crazy also. It might sound like it's what's this guy talking about? But I hope that bigger picture can be appreciated, and then I can, encourage you to see whatever you need to do to take things forward for yourself. Right? Okay, so let's jump in with the whole idea. Now, first of all, a couple of things that I would like to make very clear as regards options are concerned, right in the beginning, right up front, which is that first of all, so let's put these points. Right. Options are just another financial product through which money is made or lost. I mean, that's it. I mean, what's the big deal, right? I know it may sound very, very basic, but then this is something that you have to really, really think about, right? It's just another financial product. The thing, however, right, is that options are very unique in the sense that they have properties that no other financial product has, right? And we are going to be talking about some of these properties, right? And because of these unique properties, they, well, okay, let's put that down, which makes them really special in many ways, right? Not not just to make money, but a lot more. Right now, I'm going to be talking about what I mean by a lot more. because there really is a lot that can be done. And I'm going to be talking about data analysis of options and the insight that it can give us about what the market is likely to do, and it's like about reading the mind of the market, right? Uh, for using options well, and what would I say? How would I say this? Well, efficiently, professionally, etc., requires perhaps fundamental rewiring of one's understanding of finance, markets, and how money moves. Right now, I'm saying a lot of big, broad things, I know, but I will definitely, get into any of this. So, having said, these 4 points, and I'll probably be adding them as I get more and I get perhaps questions and feedback from all of you. Uh, we'll add to that. Now, let me first address this, a couple of things that probably all of you are already aware of, right? So, the vast public, or let's put it this way, the public or the masses, I think I'll put it that way. The retail, yes, I think that's a better word. The retail traders who do options, who or rather participate, are mostly, what would I say, very naive, and well, they do it for only one reason, right? They do it to make money, right? Which is fine. I mean, that's obviously the goal, but here's the thing. All of us are probably on this webinar at some level because you are exploring how to invest, how to trade, but the bottom line of investing and trading is, making more money, creating a profit. And some of you already know that trading options can be extremely profitable in ways that no other product allows you to make money. But at the same time, some of you, I'm sure, have experienced some pretty significant losses in options. And whatever said and done, I have come across personally very, 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 very few people. So I know quite a lot of people who are in the markets, but in that group itself, I know perhaps only a handful of people or less, I can count them on my fingers, who do options or who trade options in a significant and meaningful manner, right? When and I say significant and are actually uh, extremely few participate in a significant, meaningful manner. And what I mean by that, when I say significant and meaningful manner, is they are putting a large amount of money on the line. Right now, when I say large, I'm clearly, I have said put that in quotes, and I have no definition for large in terms of a quantity or a quantum. What I mean by large is basically putting enough that is going to keep you a little worried, that is going to keep you a little sleepless, that's going to keep you a little tense because something is at stake. For those of us who, or at least most of the people I know who trade options, it's like they'll do that small trade, that small amount, which if it goes, it's like, okay, it hurts, yes, but really doesn't damage your life. Okay, or even if it does make money, it really doesn't make anything which is significant or has the potential to take your life in a different direction. right? And I want to address basically that, because if one is, I mean, I want to start by addressing that, which is, if you're just doing this as let's be, or let me rewind. Be very clear why you want to do this. Are you doing it as a casual hobby, at an amateur level? It's like, doing it for fun, trying your luck, that sort of stuff. Then sure, I mean, there's nothing wrong with that. Just be clear what it is you're doing and from what background and intention you're doing it. What I would, however, like the session to be about is for those of us who really want to take it up powerfully and meaningfully, and talk about all the stuff that it takes to produce the amazing results that can be produced for those of us who want to, take it in some meaningful manner and address those issues. And I would like to do that, right? Right. So I'm therefore, assuming that even for those of us who have traded options in the markets at any time, you have done it from what I've highlighted, right? From some, it's not from a meaningful, deep manner. It is just, okay, let's try it out. And some of you have tasted blood. Some of you have had some really great uh, uh, results, but I don't know of anyone, at least not on the webinar today, who is doing this in what I have highlighted, right? And there are a lot of reasons for that. I think one is basically a lack of real deep appreciation of what is possible. But I think it goes maybe a little more fundamental as to understanding the nature of options itself, right? So let's first do that, right? Nature of option. What are options, right? So, and this is a very important question to understand and answer, simply because options and what they are, as you will soon see in a few minutes, are very, very different and fundamentally a very different financial product than anything else that you probably are aware of. Or rather, you might be aware of it, but you've never looked at it in that sense, right? Now, let's discuss a few basic things. If you buy a share, essentially you pay full amount for buying the share, whatever price it is. You get delivery of that share. It is either in your what is called a demat account, or it's in a paper form, and you keep it, well, for as long as you like, forever if you like, right? Price goes up, price goes down, but until and unless you sell it, there is no profit or loss which is made, right? And then we have so that's basically how 100% of the world works. Whether it's buying property, buying a car, buying mutual funds, buying gold, buying anything, this is how it is, right? You pay the full amount, you get delivery, you keep it, and then whenever it matures or you sell, you get your profit or loss. A variation of that is your futures contracts. For some of you who are already aware of it, and they are many shares bundled into one contract. It's called futures. We had a completely separate session on that earlier, so I'm not going to go into that too deeply. And essentially, futures and the spot market, where you buy the shares, are more or less the same at a very fundamental level, right? Which is, if the price goes up, you make money. If the price goes down, you lose money, right? The difference between spot and futures is just that there's a multiplier. If you make 1x profit in spot, you may make 4x or 5x profit in futures. And if you make 10% loss in spot, you could make a 40-50% loss in futures. Essentially, to make it very, very simple, futures amplify whatever happens to a stock, right? So if you're buying, say, Reliance futures versus Reliance shares, and I'm saying this because some of you are absolutely new on the market here. If the Reliance share goes up by 10%, you make 10%. If the Reliance share goes down by 10% and you're owning the Reliance share, well, at least on paper, you've lost 10%. But if you have Reliance futures, when the Reliance share moves up by 10%, you make 40-50%. And if the Reliance share goes down by 10%, you lose 40-50%, right? So basically, at a very, very profit loss level, there's this multiplier effect in futures, and that is what attracts a lot of the retail traders. They want to make quick money, and they're hoping to do that, but most of them will very quickly lose the market because they don't understand the downside. It's a natural human tendency to say, I'm going to make, but we often do not look at what you could lose or the risks or the challenges that are there. Now, futures and options can basically be understood all in one basket. But you cannot by extension, and this is the important point, you cannot by extension apply that concept to options. Options, by their very nature, are fundamentally different financial products. Or most of the stuff that you have understood about the spot market, the or the delivery based market. And again, for the sake of those who are, for the benefit of those who are new, spot or delivery, same interchangeable words. And what you mean by that is you take delivery of the product, you pay full amount, and you get it, whether it is shares or land or gold or mutual funds, anything, right, that almost everybody does. um, Options, however, are a very, very different animal that I have that we need to understand first, right? That the nature of options is fundamentally different, and what you know from probably every other area of your life may not apply to options. So let's look at options, right? Options, how will I put this, are a product that rewards you if your view of the future is correct, right? um, and when I say view has to be very specific in terms of price and time, and this is perhaps the most important thing to first understand, right? That you have to have a view, and it has to be very specific in terms of price and time. Now, before I explain this further, let's go back to what you do in your life, what almost all of us do in our life. We have a view, but it is not specific. We all have a vague view. Yeah, I will probably have my job for the next many months or many years, right? I will probably get an increment. I will probably be doing this. But if you pin people down and say specifically, please tell me, will you or will you not have the job 6 months down, 1 year down, 3 years down, 5 years down, and they just probably look at you blank. Second, if you ask them, okay, great, you're going to have your job, but can you tell me specifically how much increment you're going to have or not have, and how much it is going to be, and when is it going to be? Okay, so how much is that increment going to be, and when is that increment going to happen? Right? So you're okay, you're going to get 20% increment, all right. But telling me 20% next year is not enough. I need to know, is it going to be in January, February, March, April, May, which month is it going to specifically be? And then if you have an answer to that, it's going to be becoming even more specific. I'm going to ask you, is it going to happen on the first of the month, or on the 29th or 30th or 31st of the month? Which day is it going to happen, right? From when is that increment applicable? Now, I'm sure some of you are thinking like, now this is crazy. That's not how the world works. Well, okay, maybe that's not how the world works, but that is how options work. Because if you do not have a specific view on options, then you will end up losing a lot of money, right? The investment or the money that you put on that option product or transaction, you're going to lose money, right? Perhaps it has occurred to some of you, when I spoke about what I just did in the few minutes back, I spent some time talking about the time aspect. How many of us have any concept of time in our investments or our trades? As in, the I bought land, I bought shares, it's going to go up, but by when is it going to go up? Forget about how much it is going to go up, right? That itself is a question that most folks will not be able to answer. But the next question is, okay, by when will this go up? Because if you do not see, it works in our everyday life not to know by when. I'm repeating that. It works in our everyday life not to know by when something will happen, right? Because it's okay, and I'm not saying this in any judgmental manner. It's okay if it happens later. If it didn't happen this month, okay, next month. If it didn't happen this year, okay, next year. If it didn't happen now, sometime in the future, right? But there is a lot of other things in life where if it does not happen at that time, then you have basically missed whatever that opportunity is, right? And the best example I can give you of that is of catching a flight, catching a train, catching a bus. All right, there you have a very specific view of time. You know that the departure is at 7 a.m. or 7 p.m. You know you have to be there 5-10 minutes early or half an hour, as the case might be. And if you're going by flight, you have to be there 1 or 2 hours early, or with the international flight, 4 hours early for all the checks and balances and immigration and customs and security and all that, right? And well, if you go even 5 minutes late, which I'm sure some of us have experienced, then you are politely told and very firmly told, sorry, you have missed the you have missed it. It's gone, right? Or secure or boarding is closed, or immigration is closed. That's it. It's too bad, right? So there are other areas in life where we take time very, 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 very seriously. Okay, and we go out of the way to make sure we are on time for that. However, I am not aware of any area of life where you have to take both time and a price change into account at the same time, right? Again, going back to general jobs, it's like, yeah, I'm going to get a pay hike this year, but I don't know, I'm not sure when, sometime, right? Or it's the other way around. You know that, okay, at the end of every financial year your review happens, but you're not sure how much your increment might be, right? It's vague, right? So either you're specific on time and vague on price, or you're specific on price but vague on time. And please correct me if I'm wrong, right? In how many places are you very, 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 very specific about time and price, right? Very specific about time and price. And that is what options are. And as I will show you in some examples, if you don't do that, if you're not specific about time and price, then things will start going awry for you. And this is one of the perhaps the first and the most important things about options, that they are fundamentally different financial products than anything else that you're aware of. And if this one key point is not understood, that your view has to be very specific. When I say your view, I'm talking about the view for the stock, the view for the option has to be very specific in terms of price and time. Which brings me back to this uh, um, whole thing in the beginning, which is that requires a rewiring of one's understanding of finance, right? And because we just extrapolate what we know in other areas of life and say this is how it will probably be, but unfortunately options doesn't work that way. And this is where the rewiring needs to start, which is that any view that you have has to be very specific in terms of price and time, and I'm going to be elaborating that with a practical example. But before we go there, the closest product that I can think of which is close to options in terms of uh, risk and reward and payoffs and all those things is insurance, right? So I'm sure all of you have insurance, right? Anybody here who does not have insurance, please, let me know, and let's then discuss that. So some form of insurance or the other, right, is something that we all have, right? Some form of insurance or the other is something that all of us have. Okay, so what is insurance basically? Insurance, if you think about it, has some very clear and specific parameters, let's call it that for now, right? So there are specific conditions required for payment to be possible, right? I'm not even saying made, I'm just saying possible, right? So take a car insurance, right? Now, if you take your vehicle insurance and you take what is called the third party insurance in India, well, the thing about a third party insurance is that, if you have a accident, then what will happen is your the person who got injured through that accident gets paid by the insurance company, right? But you will not get compensated because you have a third party insurance. But if you have let's say comprehensive insurance, right, then damage to your car and maybe even damage to yourself, it is possible to pay for it, right? That the insurance company would pay for it. Now I'm saying possible because it's not an automatic payment, right? Just because there was an accident, right? Then there will be checks that are done, documentation that will have to be provided to make that insurance payment, actually happening. So if the person was driving under the influence of alcohol or something, or did not have a driver's license, then okay, possible, but denied. So there are some other conditions that need to be met before the insurance can actually be paid. All right, so there's another set of conditions, right, required to actually make the payment. All right, now when I say specific conditions required to make the payment possible, let's say specific event. Instead of conditions, we'll replace that with event. Okay, so an event has to happen, an accident has to happen, right? In the case of say health insurance, you have to fall ill, and not all illnesses could be perhaps covered in your health insurance policy, only specific illnesses, or they might very clearly say that these illnesses will not be eligible for health insurance, right? So there are very clear ifs and buts which are set out. Next, there is a time limit for the claim, right? Now, time limit for the claim, there are two time limits I'm talking about. One, the duration of the policy. If the event has to happen when the policy is live. If that event happens, that we're talking here, the specific event happens after the policy has expired, then it really doesn't matter, right? I mean, you're not eligible for it. Your policy has to be live. Second, there can also be a time limit within which you have to make the claim of the event. So event happened, you're given maybe 1 day, 1 week, 1 month to make the claim. If you don't, then you're not eligible to even claim, even though your policy is still alive. Now, these are these things I just want you to keep in mind, right? Then there is a payout which is clearly specified and calculated. Okay, it's not any amount that you want, anything that you want, right? For specific events, there will be specific payout. So if you get admitted in the hospital for 1 day, 2 days, 3 days, then you're told how much you can be getting, how much you will not be getting, for what disease, what not else. Now, if you do get admitted, then there are also clear limits on how much you will get paid. The hospital may be charging 10,000 per day, but you may be eligible only for 3,000 per day, or 5,000 per day, or 6,000 per day, right? So the payout has clear limits, and you may be eligible for only 10 days or 20 days of that um, admission, Beyond that, you'll have to pay. The insurance company is not going to pay. All right. So there's a payout which is clearly specified and calculated, and then you pay an premium for it, for the insurance. Right? You pay a premium for the insurance, right? And that is something that you pay upfront. You pay to the insurance company, and they take that money, and they do not commit to paying any of it back. Or even if you say you're going to get something back, it will only be if the specific limits, conditions, etc. are met, right? If you make no claim, and right, or let's say you make a claim but it does not meet the requirements, then you do not get anything back. Correct? I'm sure we all of us have had many happy years of having a vehicle on which you never had an accident, or if you had a small scratch or a bumper problem or something, but you never made a claim against it, right? But we kept paying the annual premium on it. Similarly, if you've taken health insurance, right, whether you took or your company took it for you, which basically came out of your pay, then you kept paying the annual premium for the health insurance but never financially benefited from it, right? Now, in order to get anything, and of course the most extreme thing is life insurance, right? You make a payment every year, and I'm talking about life insurance as life insurance, right? The only way to get money out of life insurance is to die, right? If the policy holder dies, then a big massive amount gets paid to the nominee, right? So if you do not make any claim, you do not get anything back. I mean, when you say do not get anything back, we're talking about a financial compensation, right? You get nothing back if you do not make any claims. And your entire premium is, well, lost, wasted, um, what used, call it whatever you want, right? All right. Yes, so these are your specific things. Now, most of us, even when we take an insurance policy, have no understanding, and very few people actually read all the fine print to know what all this is and how to, how it applies to you. Just go pay the premium, get the receipt, use it for your tax claims or tax benefit if you're using it as life insurance and all, or health insurance, and really nothing much else. Many people may have had this experience of wanting to make a claim but realize that they could not, or it was ineligible because it did not meet some criteria. Then you're wondering, why did you take it in the first place, right? So just pointing this out as to how we function and how the public at large does many things without really understanding what they are getting into, right? Now, till here I spoke about all this, conditions and ifs and buts and specificities and all of that, and it might be sounding like, what has this got to do with options? What's the big deal here? Well, the big deal that you and I and some of us are already aware of is that if there is a payout, it is several times the premium. Correct? So if somebody has life insurance, they paid, I don't know, 10,000, 20,000, 50,000, 1 lakh per year as insurance premium. And if they died, the payout to the nominee would be perhaps in many crores, right? It would be a very large amount of money that has been paid to the beneficiary. Same way, you pay a few hundred or few thousand rupees for your vehicle insurance, but if you have an accident and the repair is, say, a few lakhs, the insurance company is going to pay for it. Of course, subject to all these ifs and buts, right? So if there is a premium, if there is a payout, it is several times the premium, and hence very, very profitable from a financial perspective. Correct? So from a financial perspective, you're going to get 100 times, maybe 1,000 times of what you paid as a premium, and that's what makes it very, very profitable. And many of the retail investors know this in a sort of intuitive sense and say, okay, you know what, if I just put some 50,000 rupees, I might be able to get 2 lakhs or 3 lakhs out of it, but that's it, right? So what the vast numbers of retail investors and traders focus on is this, right? This part, that they could get a hell of a lot of money if they got it right, but very, very few of them focus on this, right? And this is where the big, 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 big gap to actually take advantage of the opportunity is, right? Now, before anything gets misconstrued, let's clarify what we mean by opportunity, right? You may have heard, and I'm of course not using this in the context of opportunity, but you have definitely heard of cases of insurance fraud, right? For example, somebody takes burglary insurance or fire insurance or theft insurance or whatever it is, and after taking the insurance policy, after a few days or weeks or months, intentionally sets fire to their factory or their godown or their house, or makes a burglary happen, and then goes make a claim. This is something which happens actually quite frequently, and insurance companies therefore go to a very do a lot to make sure they don't get defrauded like this. So before they settle a claim, they have all these checks and balances and investigations that they do to make sure that the claim is genuine and has not something that the insurance company was scammed into doing. And there's a term in insurance industry for this, which is called moral hazard, which is people, a policy holder, intentionally taking the policy with the intention of making this very profitable gain for himself or herself, and has planned this whole thing through basically dupe the insurance company. That's why they go through this whole checklist of things and back end investigation and ask for all that paperwork to make sure that the claim is genuine. Because very simple question, very fundamental question, if you are going to put in 1,000 rupees, or let's actually make it meaningful, 10,000 rupees, and you are literally going to, and I'm not joking, right, you are going to get not just a lakh, but you're going to get 10 lakhs, right? You're going to get 1,000,000 rupees basically, right? So 1,000,000 rupees is 1, 2, 3, 4, 5, 6, right? You are going to get 1,000,000 rupees out, right? We're talking about what is your payoff here, right? You're talking about 100x return on your investment, or if you can call this investment. Okay, so this is the premium, this is the payout, right? Return is 100x, right? Fantastic. Now just think about it. I'm not going to get into how insurance companies work, but if you were an insurance company, put yourself in the shoes of an insurance company. You are basically saying, okay, give me, the insurance company, 10,000 rupees, all right? And if certain things happen, what is this? Check. Is my sound clear? So as I was saying, if you were an insurance company and you were telling the public and the world that, look, give me 10,000 rupees, and if a certain event happens, a vehicle accident, a theft, a burglary, an earthquake, uh, 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 terrorist event, an injury, whatever it is, whatever you have insured, I will give you ₹1,000,000. The question is, where is the insurance company getting this 100x from? Okay. Now, obviously, some of you already know this answer. This 100x is coming from other people who are paying the premium, and they collectively, the insurance company uses that collective pool to make this payout. Correct. But now, if let us say more and more people make the claim, where is the company going to get 100x for every claim? Right. So please take a moment to shift into the shoes of a insurance company. Or let's put it this way: if you were running an insurance company and you were taking on this equation, which is you're going to get 10,000. If nothing happens, you will keep this 10,000. But if something happens, you will give 1 million. All right, whatever that something is. Okay. That is what insurance is. And to make it a little maybe excessively casual, which I probably shouldn't do, but still, isn't that what in a sense betting is? Right? The difference is betting and gambling, which is just a random event or sport which has nothing behind it, versus doing something which is based on data, science, evidence, research, facts, figures, etc. Right? So we can get into a separate discussion on this, but the point is, you know if you're going to take on 100x responsibility, and every time that event happens you're willing to pay 100x, then how do you feel about it? How are you going to manage this whole situation, this whole product, this whole enterprise? Right? It is obviously in the insurance company's interest that the claim does not happen. Right? And what they will get is only this 10,000 rupees. Okay? But if the claim does happen, then they have a huge amount to pay out. So understand one thing: an insurance company, and this is very important, right? Okay, let me ask the question and then let me see if someone can. How does an insurance company make money? And you will see how this is all very relevant to options. In case you're wondering why I'm going on and on about insurance, I'll come to that. How does an insurance company make money? Can someone very quickly answer that? Anyone? Akash is saying they invest in the market. Okay. Anyone else? They collect money from a few thousand people of the same risk. Madhu says more number of premiums. Prakash says government bonds. Well, doesn't really answer the fundamental question. How does an insurance company make money? So here's the thing, right? Umesh is saying it is on the claims not made from investments, and Vijay is saying premium for which there are no claims. All right, so uh, Yunus is saying when the policies expire, Ganesh is saying low risk, and Ganesh is saying investments. Okay, all of them partly true, but none of them answer the basic fundamental business case, which is if something happens, they lose 100x. Which investment, which government bond makes 100x for you? Okay, forget 100x. Even if I want to make this instead of 1 million, I want to just make it 100,000. Which gives you, if I just change this and anything which gives me 10x in, I don't know, that claim could be made in a year, right? Most insurance policies are just for 1 year. Do you know anything that makes money like this every year very consistently? I don't know of anything like that, right? And while what others have said that policies expiring, claims not being made, all that is true. But fundamentally, and I hope you really, really understand what I'm going to say next. An insurance company, let me put it here, company makes money by something. Okay, and what is that something? Okay, the insured event not happening. Right? An insurance company makes money by an event not happening. Do you get this? The event that has been insured should not happen. If it happens, the insurance company is in deep trouble. So even if the insurance company makes zero investments, does nothing with government bonds, it just sits on the money it collects through premiums and no claim is made. No claim is made, it will make money because all the premium it collected stays with the insurance company. Nothing has to be paid out. Are we getting this? Yes, no. I really need, it's important that you understand this before we move on. Anybody who has not understood this, please clarify. Are you clear about this statement? You can put a yes, no, or right. Thank you. Right. This is very important. An insurance company makes money by something not happening. It's a very different business, right? Some of you are, for how many of you are you hearing this for the first time in your life? Or are you seeing it as your first time that you ever understood anything like this? Of making money out of something not happening. You know, we all make money from something happening. You know, you're a driver, you take a person from point A to point B, you make money. You're a doctor, you treat a patient, you make money. You are a engineer, you build something, you make money. You are a marketing guy, you market something, you make money. Tell me something in your life, anything, where you make money out of something not happening. Is there anything you can think of in your life that you have done? Some of you are, have lived close to half a century. Some of us on this webinar, maybe some of us are older, most of us are younger. Non-compete fees. Okay, fine. Ganesh says government jobs, right? All right, I think those times are going, Ganesh, right? Government jobs, true, right? The problem with government jobs is, well, to get them, you will have to do something, which is give a bribe. And then to keep it also, you'll have to probably just give a bribe. So, anyhow. Um, uh, so Vijay said non-compete fees. Yeah, sure, at the corporate level, business level. But you tell me something that any of you have done in your life, okay? Forget institutions. I mean, what I'm trying to say is at a human level, at the level of our life, whatever you do personally, professionally, it doesn't matter. Tell me something that you have done in your life that has made you money by something not happening, right? I can't think of anything. Honestly, I'm at a loss myself, right? So for most of us, this itself is a fundamental concept because for us, for us to make money, right? Think about it. For you to make money, you have to do something, right? I'm now saying that when something does not happen, I'm making a very basic, I'm asking a very basic question. Does the question even make sense to some of us? Intellectually it does, but at some deeper level it's like, what's going on here? I mean, like, does this even make sense? Not something not happening, but that's the only way to make money. Well, anyhow, think about it maybe after the webinar for your own life. Let's move on, right? So an insurance company makes money by something not happening. If something happens, this something is that insured event. Me and my English, today something wrong with my typing. right? If that insured event happens, for every insured event that happens, the company actually loses money. All right. Now flip it around. For the policyholder, the event has to happen to make money. Correct? Are we on board here? For the policyholder, however, the event has to happen to make money. Now, I know when you talk about insurance, we are talking about sort of, negative or bad events. Some damage has to happen in order to make money, but we'll address that, right? But when you go into, let's say, buy a scratch card, or just maybe for fun or professionally, you go to the casino, or you are buying a lottery ticket. Something has to happen for you to make money, right? Everyone agrees with this also, right? This should be pretty obvious, right? Something has to happen, then only you will make money. Correct? So now you have the same equation here. You have the insurance contract with all these ifs and buts. Okay, you have the insurance contract with all these ifs and buts, and see how asymmetric it is, right? It is a very, very asymmetric contract. If something happens, the policyholder makes money. If something does not happen, the insurance company makes money, and the payout and returns are very, very asymmetric. If something does not happen, and stay with me on this, if something does not happen, the money that is made is very, very limited for the insurance company, which is the premium it collected. But if something happens, the payout is massive. It's multiples of the premium it collected. In other words, the policyholder is going to get multiples of what he or she paid, but the company will get only this much if something does not happen, right? So by design, this is a very asymmetric um, what contract. Yeah, that's what it is. Do we agree on all this? Is there any doubt at all in any of the things I have said so far? Any questions? Any doubts? Can I move on? Yes? All right. Problem on a webinar is you can't see faces, so you wonder what's happening on the other side. So please put some chat responses, so at least it's clear for me. It's probably clear for you, I hope. Uh, Feedback would be nice. All right, great. Okay, so by design, insurance is a very asymmetric product. So let's review this and make it very short. Insurance, there are certain terms and conditions, right? There's a very specific event, and that specific event has to happen with certain terms and conditions within a certain time frame. If that happens, then the insured or the policyholder makes a lot of money. And to provide this contract, this proposal, um, this to take on the responsibility, there's the insurance company which takes this premium. That's it. That's what insurance is, right? So it is very, very specific at many levels. Now, if you get it right, you as in, okay, let me step back, right? Now I spoke about options and insurance and all that. Now let's make the connect. Instead of insurance, okay, let's just call it options. That's it. Let's just call it options. That's it. Seriously. And the point is this: if you get everything that we discussed on insurance, all these specific things, this asymmetric nature, okay, of one person making limited money, of another person maybe making a lot of money, right? If all of this were to happen for a event which is like an insurance event but nothing but something else, right? That would be an option. The only thing where what you now have to understand is what is this event that we are talking about in options, right? What is the event, or what is the nature of the event in options? That is the question. Everything else is the same. Everything else is the same. So before I proceed, here is the next very, very important point I want to make, which is that if anybody wants to really do well in the world of options, if anybody wants to take on this profile, okay, and when I say this profile, you could take on the profile of an insurance company and vouching for an event not happening, or you could take on the profile of a policyholder who wants a certain event to happen and therefore get a multi return. If you want to do this consistently, meaningfully, and substantially, and none of these numbers are exaggerated, by the way, and I'm going to demonstrate that in a little while, then in order to do all of this professionally, meaningfully, substantially, you have to understand all this. That is your key in being able to make this happen, right? Now, we talk about health insurance, life insurance, vehicle insurance, and all of that. Obviously, that is not the event we are talking about in options, right? What is the options event we are talking about? What is the nature of this? Basically, it is, can you, and I'm going to just say pinpoint for now, the price of a stock, commodity, forex, or whatever else it is, right? Can you pinpoint the price of a stock, of the commodity, or the forex? In other words, this thing is called the underlying. Okay, can you pinpoint the point of the price of that at some X point in the future? In other words, can you say with a high level of confidence where the price will be and when it will do that? Where the price will be and when will it do that? If you can do this, right? If you can do this, then you are really somebody who is exceptionally different from the rest of the crowd, because like I said earlier, extremely few people in this world can deal with, or let me rephrase this, most people in this world have some sense of an event happening but have no sense of when it will happen. Otherwise they have a sense of something will happen, some time, in some time frame, something will something is going to happen, but they have no clarity on what is going to happen. And most of us live this sort of, what would I say, binary life. We are comfortable with this or that, but how many of us are comfortable with both? You are able to say what is likely to happen and by when it is likely to happen. And it is literally like peering into the future and being able to say what outcomes are round the corner sometime in the future. And I'm not exaggerating and I'm not joking when I say you do, in a sense, become a futurologist. You are making predictions about the future. You are taking on the risk of being wrong a lot of times. But if you are right, then this is what awaits you. Right? So, what is the options event we are talking about? What is the nature of the event? Can you say with a high degree of confidence where the price will be? Or some of you, I should correct this, right? Uh, where the price not will be is very likely to be, and you know why I have crossed out the word will, because will can only be used by God, right? Where is the price very likely to be? This is important, very likely to be, and you can do a pretty good job at doing it if you get serious about it, right? And when it is, when also will it do that? Will it do that this week, next month, 3 months down the line? You've got to have some time frame, and you can't be vague and say the price is going to be up next year. You've got to be a lot more specific, right? And can't be vague. So I challenge you on one thing, right? One of the things that you're going to have to deal with if you get into options seriously is, earlier I said you're going to have to rewire your mind, a fundamental rewiring of one's understanding of finance markets, right? This is what I mean. One of the fundamental rewirings is you've got to stop being vague in life. You will you will be forced to stop being saying making statements like, yeah, our price is going to go up, buy that stock. That's good enough to buy a stock, but that is a dangerous game to play if you're doing options, because you have to be clear. And I'm going to get into exactly what I mean by that. But if you say the price is going to go up by, and you don't know, then you're very likely to lose money on options, right? You can't be vague, and therefore requires a very different type of thinking, analysis, and rigor than what you are used to, generally speaking, right? So how many of you are up for that? How many of you, by the way, one of the things I'll tell you right now is, any of you taking up options, apart from the whole thing about making money, you are going to also have, you're also going to start looking a lot of things in life very differently. Why? Because this sort of very specific thinking and analysis will start to creep into other areas of your life. And from Godwin is saying, I'm used to tossing coins right now. Well, Godwin, not good enough at all, right? If you're used to tossing coins right now, then you're going to have to, learn things like the torque of a coin, the balance of a coin, the distribution of that metal evenly across those three dimensions of the coin. Is it correctly balanced, not balanced? If it is unbalanced, then on which side is it unbalanced? And then, okay, he says stop. Okay, I'll stop. But if Godwin can do all that, if Godwin can do all that, which he can, and all of us can, then it's not tossing a coin as in 50-50. It's actually saying, you know what, 89% of the time it's going to come heads, and 11% of the time it's going to be tails. You're going to get that. If not that specific, let me put it more accurately. You will have to come to a point and say, there's an 80 to 90% chance that the coin is going to be heads in the next 200 tosses. As long as those 200 tosses are done in winter before, say, mid-Jan, we are in December right now, it's going to have to become that clear for you. Now, if you can get that clear, then the sky is the limit, and I'll show you that in a little while. So you can't be vague, right? Godwin is asking, can the price need to be exact or can it be in a narrow range? I will answer that question with some live examples, right? So you can't be vague, right? And so price and time specific, right? So let's maybe I've spoken a little too long about the idea and the concepts and all of that. Let's make this real. Okay, let's make this real. Let's make this relevant and show you what exactly I mean by price and time specific in your views, right? So this is about having a view that is specific in price and time on which you can confidently uh, put your money on the line. This is what it comes down to, right? Having a view that you're confident about and you're willing to put money on the line, and it has to be specific in price and time. So let's make it a real thing first, and then I will show you some examples. Today is Sunday, right? Yeah. Friday or Thursday, there was a stock which rallied up very, very handsomely. And let me introduce that to you very quickly. I'll give you the backstory of it first, and then we'll talk about it in more details as far as options is concerned. Right. So this is a stock called Bharti Airtel. Right. I'm sure everybody has heard of Bharti Airtel. Anybody has not heard of Bharti Airtel? Right. Okay. So telecom company, stock called Bharti Airtel, and this is what it did in the last 2 days. And what it did is this stock was at around 490 rupees, this yellow line, and right now it is at 530 rupees. So I'm talking about this move. I'm talking about this move. So just to be clear, can everybody see Bharti's chart at your end, please? Can you confirm? Right? Okay. Right. So forget about all the other lines and colors and all these things. We just stick with what we want to achieve with the whole idea. So Bharti Airtel went from 486 rupees to 526 rupees, right? So let's do some math. Bharti 526 486, right? So in other words, a gain of 40 rupees. Okay, current market price 2 days back, right? So 40 rupees, and we are doing this session on the 10th of December 2017. So this was the price behavior of the stock on 7th and 8th of December, okay, 2017. Now, in terms of 20 rupees INR, Indian rupees, in terms of percentage, that is equal to 40 rupees on a base of 486. So it did a 8% or 8.23% move in 2 days, right? Now, if you made 8% in 2 days, fantastic. I mean, obviously, it's a great move. Okay. Now, I know some of you are having these questions about could you have found the move? Could you have seen it coming? I know. I mean, for the purpose of an introduction, I'm using an example that already happened. But believe me, for anybody who is doing this professionally, and that does not necessarily mean giving up the rest of your life to do only this, right? But what professionally does mean is you're doing it with a proper process, procedure, approach, seriousness, commitment, etc., right? So we're talking definitely about all that. Now, 8.23% up move happened in 2 days. So happened over, let me just put down the dates because time is important. 7th and 8th December 2017, right? Okay. So let's put it differently, okay? Or let's put it very simply. If you had bought some, say, 100 shares, or let's say you put a 1 lakh rupees in Bharti Airtel at 480 or 486 rupees, whatever the case might be, right? And you've done this, let's say, even a week back, right? Because this is a price which was there even when was this? This was sorry, 23rd October. So from 23rd October, this yellow line, if you see, the price has come there once, twice, 3 times, 4 times, 5 times, 6 times, then 7 times, 8 times, 9 times. So they were 10 days. Okay, they were 10 days in almost what um, about 1.5 months. Okay, there were 10 days in a 1.5 month period where this price, which is on the yellow line, had been achieved. So let's again, maybe theoretically, but actually for me, it is a very, very practical thing to do. For some of you, it might look very idealized, but believe me, it's not. It is something very practical. I have no intention in anything in BIC to talk about things which are not possible. I only talk about things which are possible to do consistently and regularly. And those of you who have come for BIC events and courses, I hope you will vouch for that. You have seen that repeatedly. Anyhow, so there was plenty of opportunity to actually get this price of 486, 485, 490, doesn't matter. If you had done that, and if you had invested 1 lakh rupees in the last 1.5 months, and you had been sitting on it, at this point, you would be making 8% maybe over a month. And if you did that 3 days back, you would have done it, you would have been an 8% mover in 2 days. And just to hit things home, because some of you on the webinar today are folks who have never been in the markets. Such people are probably happy with 8% fixed deposits over a year. You're talking about 8% in a week, in a month, in 2 days here. I mean, just think about it. Of course, there's a downside, but I'm just trying to convey the opportunity which is there. All right. Now, 8% happened in 2 days. My question as far as options is concerned, and coming to the question that Godwin asked and everybody has in mind, right? We said you can't be vague and you have to have a view which is specific in price and time. Okay. So let's now make this very, very practical. So options, just like insurance products, have a lifespan. Your insurance product or insurance policy is for usually 1 year. Option policies, for the sake of understanding, you don't call them policies, but for our practical purposes, they work the same way. Let's say the option is valid for 1 month only. Practically speaking, that's how it is in India. It could be very different in foreign markets, but in India, let's say your option is valid for 1 month. Now, the option has to be specific in price and time. So here is what we're going to assume, right? We are going to say that I want an option, right? Or I am looking at an option, let's put it that way, which is the following. Let me first put a line there. Yeah. Right. So this, aquamarine line, blue line, and what is that? So the option that I have is going to say the following, right? Let's say the price is here right now. Okay, just bear with me. The price is here right now. The price is below the blue line. Okay, and let's put one more line. I'll put that here. So just to be clear, this blue line, and let me make this a different color for the sake of clarity. Pink. Yeah, right. So there are three colors you have to be concerned about right now: the yellow line, the blue line, and the pink line, right? If anyone is missing anything, needs clarification, please ask. This is very important on the practical side. So we have the yellow line, we have the blue line, and we have the pink line. Please note that the price has been below or between the yellow line and the blue line for a long time, and it had gone above the pink line. And what I'm trying to do is make it as practical as possible. And let's say you're here today. Okay, so this is today. This is today, right? And we're going to take it one day at a time. So what you see here, the red and the green are candles or 1 day sessions as in this chart, right? Now, this is what is happening to the price. The price is here right now. It is at 482, 492, right? And the option and the specific view I have is that by or before the end of the month. So we have to be clear about what we mean by end of the month. Some of you already know that in India, option contracts expire on the last Thursday of the month. We are somewhere on the 4th or 5th on this chart. So I have 1, 2, 3, 4 weeks or 3.5 weeks. I have 3.5 to 4 weeks of time. Okay. And I'm going to come back to this. It's very important. And I am saying that I have a view which is within the next 3.5 weeks before or on 28th of December, which is when the contracts expire. Indian option contracts expire on the last Thursday of the month. Then you have a fresh contract available for January, February, March, etc. We'll get into those theoretical and back-end details later. But for now, so the view is what? That in the next 3.5 to 4 weeks, or let's pick it very specific, before 28th of December, Bharti's stock price is going to be above 500. And another view is Bharti's stock price is going to be above 520. Now, please note, what have I now said? I have said something very specific. I have said before a certain date, the price is going to be somewhere. Second, I've given two different views on the price. One is before 28th of December, it's going to be above 500. And that does not mean it will be above 520. It just means it will be above 500. It could be at 510, it could be at 505, it could be at 550, it could be at 600 also. But if I say it's going to be above 520, then that's a different view, right? Because 519, if the price is 515, 510, then it is above 500, but it is not above 520. Are you getting the sense of this specificity business that we are talking about, that you have to be specific in your views, right? You have to be clear and specific in your views, because if the view happens, there's a certain consequence. If the view does not happen, then there's a different consequence, right? So let's make it a little simpler. I'll have only one view. Okay, so let me bring in another thing and I will come back. I can also have a view that the stock Bharti will be above 500 by the end of March 2018. Okay, by the end of March 2018, that is 3 months from now, 3.5 months from now, Bharti will be above 500, which is a very different view than saying Bharti will be above 500 before 28th of December 2017. Are we clear about it? So when we say specific views, they are in time and price. Somebody else saying, yes, I think Bharti will go up to 500, but it won't happen in December, it will happen in January. That's a different view. So you have to be clear in your view. Now let's see what happens if you're clear in your view and if the view happens. So the view is, let's note it down, Bharti's stock price is likely to be greater than 500 on or before 28th December 2017. Are we clear? Changing this, okay, or this changes the view. If somebody says greater than 510, that's a different view. If somebody says less than 500, that's a different view. If somebody says less than 480, that's a different view. If somebody has a different date and time, that's a different view. Okay. If somebody said this will happen before 15th December, that's a different view. If somebody else says it will happen before 14th December, that's a different view. Right. So this is what I mean by specific. Right. I hope you're getting clear. Now, please note when we said specific here, we did not say it will be exactly 500. We said above 500. That means 501, 510, 550, 600, 700 is all fine. We did not say it will be exactly 500. And we did not say on 28th December. We said on or before. It can happen anytime between now and then. So you are actually building a window. You're not being that precise. It's not precision engineering that we're talking about. We are talking about a view which has some specific parameters. It could be more, or if I change, say, instead of greater than 500, if I say less than 500, then it could be anywhere less than 500. It could be 450, 350, 100, 50 rupees, 10 rupees, doesn't matter, right? But you have these cutoffs. Let's put it that way. You have this very, very clear, unambiguous cutoffs. All right. Now, irrespective of what happens, right now, okay, let me rephrase that. So if this happens, well, it happened. The stock price went to 526 right now. Now, was I absolutely sure that the stock price would go up by 40 rupees in the last Thursday, Friday? It will happen on these 2 days? No, I was not sure about that. What I was sure about is that it's very, very likely to happen in the next 2-3 weeks. It could happen as I speak. It could happen just in the nick of time on 28th, or it may not happen. Right? But I'm giving myself a window in which to happen and how much it will happen. It just so happens that this is when it happened. Right? Sorry about the jumbled up English, but I'm hoping you're getting it. Okay, it just happens that it happened. Okay, what's important for me, it has to happen within my constraints. Right? The constraint is above 500 and before 28th of December. And I know some of you are thinking, okay, Musa, let's get on with it. Okay, let's get on with it. So this happened. On the spot price, you made 8.23%. Do you know what you could have made in options? Now you have to have an option which supports this view. That's the point, right? And technically, this is called the Bharti call option of December expiry, of December 17 expiry with a strike price of 500. So this is technically put. This view is now technically stated in the market jargon, right? So what is the strike price? What is expiry? What is a call option? All that is later. For now, this is the view that has now been stated in technical terms, and there has to be a contract which provides for this view, and there is. So if I very quickly take us to the NSE website, okay, and I put Bharti, Airtel here, and I'm saying something called option chain. For those of you who don't know any of this, that's absolutely fine. Don't worry about it. Now, just to tell you and show you different contracts for different views. Right now on Bharti, you have call contracts, call options, and you have put options. I know I have not defined this. I will come back to this. In the center, you have all these strike prices, right? And you have strike prices all the way from 270 rupees, to 620 rupees, and this gives you a snapshot of the trading and the activities that are going on in Bharti options, not Bharti stock, in Bharti options for the month of December. Right? This is not for January, this is not for February, this is not for next year. This is for December 2017. This is, and as on Friday 9th, sorry, 8th December close. Today we are doing this on a webinar on a Sunday. So this is how it is. Okay, this can change day after tomorrow, when the markets open, etc., etc. So this is various different contracts available to support various different views that are possible. So what happened? Now let's get to this. Okay. So what you're seeing here is the chart of Bharti. Sorry, and I'm going to make it more interesting. Sorry. Stop. So it's the same chart you saw, but in a slightly different format. Okay. This is what you saw earlier. This is what I regularly use for my own analysis. So I'm just more comfortable with it. But essentially, the information you're seeing is all the same. There is absolutely no difference. So you're essentially seeing just this much of the screen here. This much of the screen, you're seeing it on this chart. Same thing, little less complicated, a little simpler. So this is Bharti going from 486, 485, right, to all the way to 526. This is the Bharti stock. Now I'm going to show you what happened to the price of the option. Which option? This option. The Bharti call option of December 17 with a strike price of 500. And here it is. Ta-da! This is on the is a bit of a conundrum to use. Bharti Airtel. Right, there you have it. Right. So I'm just aligning the charts in terms of time. So everything is now time synced. So this is Bharti going on the left from 486 to 526, and the option went from 8 rupees, okay, 8 rupees per option to a high of 30 rupees per option. The high was 35, it closed at 30.31, from 8 rupees to 30 rupees. right? This is like that insurance payout you have. If Bharti stock goes above 500, here, right? If it goes above 500, this yellow line I've put on the left, make it really thick, then I get rewarded for that view. If it does not go above 500, then the option will not do this. So the view was it should go above 500, or it's likely to go above 500, and now I'm putting money on the line for that view, and for that I'm going to buy the option contract, not the stock. I'm going to buy the option contract, and it's like buying that insurance policy where if the event happens, you will make a lot of money. If the event does not happen, that premium is gone. All right. So how much did I pay premium? And by the way, in options world, this is also called premium. 8 rupees is the premium. Now 8 rupees is not as simple as that. So 8 rupees, for all practical purposes, let's make it 9 rupees, okay? Because it's very easy to say you could have bought it right down here. Practically speaking, you could not have. Say even 10 or 12 would be fine, right? So we'll just make it 10 rupees. Now, when you buy the contract in Bharti at this point as we speak, one option of Bharti has 1,700 shares, right, in it. So again, it's called lot size. Right? That's the technical term that is used. Okay? For those of you who are new, it doesn't matter. Don't fret about it. Just remember this 1,700 is a fixed quantity. It's a fixed number that will not change on its own. What can change is the price. Okay, so this is price of the option. Right. So 10 rupees is the price. 1,700 is the number of shares in it. So you'll have to pay 10 rupees per share of Bharti option, not Bharti shares, of Bharti option. In other words, you have paid INR 1,000, 17,000 rupees. Are we clear? You paid 17,000 rupees for this transaction plus about 150 rupees or so as transaction cost, brokerage, etc. So your total cost is around 17,150 rupees. That's it. Now this 10 rupee option became how much? It is now at 31 rupees. It is now at 31 rupees, right? So the same option is now 52,700 rupees. Well, you tripled your money. 10 rupees per option share became 31 rupees per option share, and that happened in 2 days. In 2 days. For somebody who wanted to look at this earlier, yeah, you could have looked at it earlier when the price was, let us say, already at 500. Okay, that time the price was 20 rupees. If you were holding that right now, 20 has become 30, but also remember, so this is the practical part, 20 going down, sorry, this 500 rupee becoming 486, 20 became 8. So before you get all excited, 20 became 8, but 8 became 31, or 20 became 31 if you had bought it here. Well, let's take a pause for now. Does anyone have anything to say about price tripling? Godwin is asking, so at the end of it, one is left with 52K or 52K plus 17. No. So you bought it at 10, the option, you can sell it at 31. So 17,000 that you invested has become 52,700. Your profit is 52 minus 17, right? 35,700 is your profit. If you want to calculate it in terms of percentage, you're talking about 35,700 on an investment of 17,000, which is a 200% return. 210%, 2 days. Let it even take 4 weeks. I don't care. But in terms of payoffs, in terms of this that I was talking about, all right, this is as things are at this point. The strike price is 500, right? It is very, very possible that Bharti will continue to rise for the rest of the month. We are still having 3 weeks, okay? Still 3 weeks for this price to go up or down. And the question is, or let's put it this way, if you have taken this transact trade already, you can get out right now with a 210% profit or 35,700 profit, or you could hold on to it, and this 30, who knows, could become 50, 60, 70, or 30 could go back and become 20, 25, 10, 0. If the price is below 500 before 28th of December, I'm reiterating this, if the price is below 500 for this option before by 28th of December, the 17,000 will become 0. All this 10 will become 0. 9, 8, 7, 6, 5, 4, 3, 2, 1, it will become 0. 50 paisa, 10 paisa, 0. So worst case scenario, you may lose all of this if this view does not happen. But if this view does happen, as you've already seen it, there is already 210% to be made, and this is per contract. Per contract. Well, if you bought two, you would have paid 34,000 rupees and you would have had 70,000 rupees profit by now. That's it. That is the opportunity. There is also the risk. And question is getting your view right and getting the contract right. That is where the real challenge is. Most people just put some money here, there, and take a shot at it. There is a different way to play the game, but I would prefer to focus on the real professional approach, consistent approach, repeatable approach. Well, if you do that, then, well, my friends, this is just one example of what is possible. I'm happy to show you more. Before we move on, before we discuss anything else, any thoughts, any ideas, anything going through your mind, please, I would definitely request you to put it up here. If you would prefer not to make your thoughts and views public, ping me privately or put it on WhatsApp or something. But I'm going to just take a pause to give you time to think or time to reflect on the possibility and opportunity, and we can continue. So while you do that, I'm just going to have a glass of water, but don't go away. Need to pick up your glass, do that, but be back in 30 seconds. And anyone around, put in your thoughts and ideas, or use the mic, open up the mic. I'd really love to hear what you have to think, what's going through your mind. I'd love to see your faces actually at this point. Hi, Vijay has a question and he's asking, in terms of your insurance example, this means the company would lose 52,000. So why would the insurance company undertake this contract? Very good question, Vijay. Right. Um, so let me rephrase Vijay's question. So, you know, Vijay is saying 52,000 rupees the company is now losing. Why would they undertake this contract? Does anyone have an answer before I give a response? Does anyone have an answer before I give a response? The answer is on your screen, which is the person who had a view, right? This person, the option holder in this case, right? So instead of the policy holder, it's the option holder, right? Has a view that Bharti is going to be 500 or more before a certain date. What do you think the insurance company's view would be? How would the insurance company make money? Remember, just to make this even more practical, and thank you for the question. On the right side of the right chart is the option chart. On the left side is the Bharti chart. What do you notice? You notice this? You notice this option or this insurance, for the sake of our understanding. We are taking this example of this nice, handsome move from 8 9 rupees to 31 rupees. But this was also at a much higher price of 2022 rupees on 23rd of November. This contract was available in November end, and at that time the price was 20 rupees. At that time, the price of Bharti was 500 rupees and perhaps was looking like it was going down here. But to answer your question in a very simple manner, the insurance company took this contract or undertook this contract, that's the correct word, undertook this contract because in the insurance company's view, Bharti would not go to 500 rupees before December end. If Bharti does not go to 500 rupees, this is what that not happening is. Okay. Bharti can be anywhere less than 500, doesn't matter, but it cannot be above 500. That's all. If it is not above 500, then the insurance company would make this money. It would keep 17,000 rupees. Does that answer your question? Some other responses have come. I missed it. Umesh says other investors would have different views and put the money. Prakash says they believed in the opposite. Right. Right. So Prakash is asking, okay, in this case, who's the options company? Well, okay, good question. There is nothing like an options company, right? There is nothing like an options company. You could be the options company if you wanted. You could be the one who's taking on the risk and saying 500 will not happen, and you are the one. See, okay, so let me make it a little uh, more practical. Now, when we took this example and we said we bought it at 10 rupees, correct? Well, if you bought something, then somebody also sold it. It's just the other side of the coin, right? You cannot have a transaction where there's only one buy, where there's only a buyer but there's no seller. Every transaction has a buyer and a seller. It's two sides of the same coin. So if somebody bought at 10, then somebody sold at 10, right? And the person who sold at 10 is, to use Prakash's terminology, is the options company. Now, who could that be? It could be you, Prakash, if you wanted. And if you sold it at 10, then now if the buyer wants, you'd have to give him 31. Uh-huh. Yes. Oh, yes, exactly. So in the financial market, you could be the buyer of an option, you could also be the seller of an option. There are some technicalities associated with all this. We'll deal with that, in the proper classes, not in the introduction. But for now, just very practically, very relevantly, this is how anything works. For any buyer to buy, there has to be a seller to sell. So for any option, for you to buy this option, there should be somebody to sell this option. Maybe it was me. Let's put it this way. If Musa sold this option at 10 rupees, then Musa is sitting on a loss because it's now worth 31 rupees. Because sold it at 10, but the demand can be for 31. And if Prakash, you bought it at 10, well, you can now come to Musa and ask for 31. Now, in the market, you don't know who the counterparty is. That's a different thing. And there are ways the whole thing is managed where there is absolute risk-free um, guarantees of the transactions being honored. We're not talking about profit and loss. The transaction will be honored, right? So just one more point, right? In order to make sure that transactions are honored, etc., sellers of these contracts, as in this example, have to provide a margin money or a deposit to the exchange. So every seller would be required to place a margin money or it's called margin money, okay, with the broker, and that ensures that the seller honors the deal. So does that answer the question for you also, Godwin? Where does your profit come from? All right. So in options, buyers don't have to put margin money, but sellers have to put margin money. For those of you who have been doing futures, this is one important key difference. Okay, in how you can use your money, it's far more efficiently used in options than in futures. Right. All right. Just on the side, because some of you are in futures, well, you show me, 210% returns in futures. Okay, show me 210% returns in futures. And this is for who are in futures, right? Just telling you about what futures versus options. Godwin is asking, buyers don't have to put margin, so how does it work when it does not go in my direction? So first of all, are you a buyer, Godwin? Is that what you're saying? Yeah. So what will happen? Worst case, you bought for 10 rupees, or like in this example, you bought for 20 rupees, and price keeps going down, down, down. So you bought for 10 and the market had not gone up. If Bharti had not gone up and if Bharti had gone down, what do you think would have happened to your 10 rupee option? Would it have become 98765? And finally, what's the worst case scenario? It will become 0. Thank you. So, and I mean, jokes apart, it is correct what you're saying. It can become 0. So this is one big difference in the spot market versus options. In the spot market, you don't expect your stocks to go to 0. Not that they can't, but we just don't expect something like Bharti share, which is at 500 rupees, to become 0 overnight or even over 10 years, right? Not that it can't happen, but in spot, okay, so this is another big point again. This whole idea that you have to rewire your understanding, okay? Rewire your understanding. This is a very important point, right? You have to rewire it. In options, your investment can go to 0, and if it does go to 0, well, you lose all your money. So yes, what you're saying is your 17,000 can become 0. How many of us are willing to accept that sort of risk? I don't think many of us are, right? Okay. Yes, Prakash, what you're saying is right. You lose your investment, you lose your capital. And Godwin is asking, your margin is separate from the 17,000? Yes, your margin is separate from the 17,000. But again, I don't know what exactly you mean by your margin is separate from 17,000, Godwin, because the seller, there is no 17,000. The seller has to give margin and he gets 17,000, right? The seller gets this money. The buyer pays this money. Now the buyer has this much. It's worth this much. Yeah, if you were selling instead of buying, then you'd have to give a margin. It could be a couple of lakhs. Any seller has to give margin money, and that will be calculated by the exchange and the broker. And there's some, there's a logic and a math behind that. All right. Any other questions? No? All right. So let me show one or two more examples for you to get a sense of what we are talking about. And I must warn you at this point, if anybody is starting to see, their castle in Switzerland and their Mercedes Benz in the garage next week, hold on. It's not that easy. It's not that fast. It's not that simple. Prakash is asking, neither the buyer nor seller actually owns the share. That's absolutely right, Prakash. Right? Neither the buyer nor the seller actually owns the share. Gordon was thinking of McLaren. Yes, that the 1:34 scale McLaren. Yeah, that's possible. All right. Prakash Naidu is asking, so does the seller get the first and then give the margin from 17,000? No, you have to give the margin first. Okay. All right. So let's look at some more examples, real world examples, and this time let's take Nifty. So as all of you know, right, Nifty is the index, and this is what the Nifty has done in the last October, November, December. This is a daily chart of the Nifty. We can do intraday also if you wish, right? But let's leave that for now. And since we are in December already, we will look at the December contracts and not look at anything from the past for the purpose of the session. Okay, so what you see here is the Nifty had gone to 10,500 almost, then had come down to 10,100 something, had come back to 10,400 and then made a low of about 10,044 and then has bounced up very handsomely from 10,044 to 10,267, right? So almost 200 points up. Okay, so the Nifty, which is the main index for India, has moved up 200 points in 2 days, right? And just in case anybody was wondering, talking about technical analysis, etc., just inviting you to observe a few levels here and think about, whether it could have been found out, expected, these levels. And of course, I'm not looking at anything else here. I am just keeping this very simple, a very simple chart analysis. Anyhow, so it came here to about 10,100 plus minus 40-50 points, and then the Nifty has bounced up. Okay. Now let's look at some options, right, on the Nifty. Okay, which reminds me, I totally forgot, right? So I'm going to step back and I'll come back to the Nifty, sorry. You remember when we were discussing for Bharti, I said you could have a different view. You could have one more option here, but for 520 and not for 500. So the difference is here, right? I could have a different view. Date is the same, December expiry, But for 520, that means the price has to be above 520, right? Let's see what happened to that. So this was on the right side of the screen again, please, for the 500 call option, right? If I make this the 520 call option, as you can see, there are many different options available. If I make it the 520 option, right, it also went up, and this one went up from 3 rupees to 17 rupees. 3 rupees to 17 rupees, a high of 21 rupees. Let's put this in perspective, right? 3 into 1700, you're talking about, you would have just spent 5,000 rupees on the option. It is now 17 rupees. Your 5,100 rupees plus brokerage would have become 28,000 or almost 29,000. That's your profit, and that is equal to 467% profit. 403 rupee option became 17 rupees. It was 3 rupees here, okay, became 17, a high of 21 also. Okay, a high of 21 also. Let me make this practical. Right, 3 would not be possible. Actually, it's not impossible, but it's retrofitting it in the back. So let's give ourselves ample place for errors and doubts and time to guess and time to observe. So instead of 3, we're going to make it 5. But instead of 17, if you were trading correctly with stop losses, trailing orders, etc., you would have easily gotten out around 18 or 19, right? So when I say 18 or 19, that's because I went to more than 21. I'm going to put 18 here, right? You made 260%. And by the way, if you were actually able to get in at 3, which you just have to trust me on this, if you pay enough time and attention to all of this, you could have gotten at 3 or 350 or 4, right? So you could have made 500%. 5,000 rupees became 30,000 rupees. You could have bought 10 contracts, by the way, if you wanted. Okay, this was per contract. It was per contract. If you had 50,000 rupees, your 50,000 rupees would have become 3 lakhs. You would have made 2.5 lakhs in 2 days, 1 week. Definitely possible. But again, that 50,000 rupees for 10 contracts could have become 40,000, 30,000, 10,000 also. But as some of you who are in the markets who are trading already know, there are things like stop losses, stop orders, etc. And you take advantage of that, then you can limit your downside and loss. Right now, again, I have to emphasize, these are not just some random trades that you take and just put your money and throw it around. This is done after you have a view. Okay, after you have a view that has to be very specific in terms of price and time. So be very clear. You want to do this sort of things. Okay, building a view takes time, practice, patience, and hard work. Okay, now when I say hard work, it doesn't mean toiling the whole day like a donkey. I'm saying being persistent, being patient, using systems, and just waiting. And when the opportunity comes, you got to, the hard work is in retrospect. Once you figure it out, it obviously looks easy. It's like showing examples, like, oh, okay, how come? But there was investment of time, effort, knowledge, experience, and some horrible losses behind all that. And then you start putting the jigsaw puzzles together. Well, when that starts to happen, then this starts to happen, right? So inviting you to think about that. All right, so the point here to show you was that the views are different, the prices are different. First one was 10 to 31, Here the price is 3 to 18, right? You also saw it could have been 5 or anything, right? And by the way, one very important point about options, which is not like your insurance policy. In insurance policy, once you buy it, you cannot unbuy it. You cannot go back to the insurance company and say, okay, fine, you know what, I want to get out of the policy. What's the price? You've taken a commitment, then you can only wait for expiry of the policy or an event to happen. In trading, in options, you can get in and out at any time you wish. You can buy it at any price, and immediately after that, you can sell it at any price, whatever is available after that. Right? You can buy it you can buy it and then sell it 5 seconds later, 5 minutes later, 5 days later, 5 weeks later. You can sell it any time before expiry of that contract. So that is one big difference between insurance policies and option policies, or options rather. All right, so that was to show you how a different view played out. It's also, because we are discussing, you can also have a view. As you can see, there are many different prices here. Okay, 520, 540. Let us say 560. You can see that this also went up, but this was only 1 rupee option. 1 rupee 50 paisa. It became 4.5 rupees. Went all the way to 6 rupees also. Right. So 1 rupee option went to 6 rupees, closed here. Right. Some other trades options, maybe the trade itself did not happen. 580, you can see very few candles. That means there was no liquidity, there was no trading. But the 60 paisa option, 40 paisa option went all the way to 340 and then came down. Right. Okay, so that was about Bharti. Now let's get back to the Nifty and the Nifty's chart on the left that we were discussing. So I'm going to show you multiple things, both the upside potential and also the downside potential. So let's look at this up move that happened first. Okay, or we look at the whole thing. So I'm not going to look at the Nifty option, and I'm going to look at, let's say, just the 10,000 call. You can see, by the way, which option to take, at what price to buy, is an art in itself, right? Please don't take anything that we are discussing today and just go blindly implement it. It's not as simple as that. If it was, I can assure you there'd be a lot more billionaires and millionaires walking this planet, and everybody in the stock market would have had their McLaren by now. That's not the case, right? So we are showing you things where, when everything comes together, this is what's possible. But for everything to come together, there's a path that you're going to have to walk. Anyhow, so this is the 10,000 call option for the Nifty this time. What do you see? First of all, notice that on the left side is the chart of the Nifty. On the right side is the chart of the Nifty 10,000 option. Looks very similar to the Nifty itself in terms of pattern, in terms of moves up and down and all these things, right? Now let's look at the price. So we can now actually compare point for point, because it's so easy, because it is so intuitive and one over the other. So if you look at this option, when the Nifty hit 10,500 or 10,460 at this point, you're following me on the screen. Can you just confirm? You can see my cursor. There are no lags between what I'm saying and what you're seeing. Yeah, okay. The Nifty at 10,400, 10,450 here. At that time, this 10,000 option was 560 rupees. 560 rupees. All right. So 560 rupees is the option, right? And you now have the Nifty falling all the way to, okay, let's actually make a table of this, because there's something very interesting for you to observe. So we're going to put, what is this, 6th November. Okay, so I'm just going to do one thing and I'll bring the screen back. I have a multi-screen system at my end, so I'm just going to drag this off to my secondary screen. I'll put the numbers there, then I'll drag the screen back for our reference. So I'm putting this, so that was the 6th of November, right? Roughly there. 6th November, Nifty is at 10,450. Okay, and the Nifty 10,000 option here is at around 540, 560. Right. So we have the date, we have Nifty, we have the 10K call. Right. Then we come down to the bottom here, and this is 15th November. Right, and the Nifty here is approximately 10,140. And the call option here at that time has become, right, 15th has become 300 rupees. And then here 27th November, okay, the Nifty is back to around 10,380, and the 10,000 call here is around 460. And then the Nifty falls to say 10,050 here, and this is 7th December, 10,050, and the option at that time is about say 200, and right now this option is at 520 at 325. Nifty is at 10,250, and we are on yeah, 7th December. Like this. So, all right. So this is what I was just filling in, right? So let's look at it from multiple perspectives. By the way, the lot size, as Bharti's lot size was 1,700. Nifty's lot size is 75. Right? That means, right, for every contract that you take, you are actually buying 75 of these. So just to get the prices, so that it's practical and not something theoretical, we're talking about. All right. So that's the amount of money you would be needing to enter the trade. 42,000 rupees, 22,000 rupees, 24,000 rupees, getting in or out, whatever it is, right? Okay. So we're going to use this data now to, to look at what one could have done, not done. So coming to the chart, again, so let us say that you were tracking the market on a pretty serious basis, pretty regularly, etc., and all that, and you felt or you saw this turn coming, you saw this up move coming, and you said, okay, I'm going to take advantage of this up move and I'm going to jump into the market, and you did that through options. Okay, you did that through options. So that means when the market was around 10,050 or maybe 10,100, you saw the up move coming, you expected it to go higher. And by the way, there were studies, or there are studies and I'm saying this because I was following this and I was tracking this and all that, which could have told you technical studies that an up move was coming, that this down move was ending, right? That the down move was ending and an up move was coming. You could have anticipated that on some really good analysis of the charts. I'm not going to go into that in this session. So you did that, you anticipated the up move coming. You were not sure how much the up move could be, but you anticipated it, right? Again, you could have anticipated how much the up move was, right? And that's a separate discussion, but the down move is over, up move is coming. You're saying, take let me put money on that view by buying the 10,000 call, and you would have bought the 10,000 call at around this price, the right side of the chart. Okay. The right chart, right edge. Around 200, 220, you had bought this option. It is now trading at 328. So in other words, you bought it at this price, you paid 15,000 rupees, and now you are sitting on a profit of 24. Sorry, your investment of 200 per share had become 325 per share of the Nifty 10,000 call. Since you bought 75 of them, that's the blocks in which you have to buy. 15,000 rupees has become 24,375. Let's basically say you made a 10,000 rupee profit in 2 days. A 10,000 rupee profit is a 66% return. Is a 66% return in 2 days, right? So that is what could have happened, right? Now, again, just to point out to the question that was asked earlier about making money and who's writing options and all these things. Well, think about it. If the option person who had sold the option, okay, somebody obviously sold an option here at around 560 rupees, sold it and saw it go all the way to 300, also saw it all the way go to 200. What that person sold, the option company, as Prakash so nicely put it, though there is no option company as such, right? Let's put that, yeah. So around this price, somebody sold, and around that price, well, that person who sold it, let's say, decided, let me get out of that contract. So sold for 560, bought it back for 200, made 360 rupees. This price minus this price. On the other hand, if somebody had bought at 560, well, at 200 or even at the current price of about 320, the person who bought it here, would be sitting on a significant loss, right? On the other hand, somebody who bought it here at the lows is sitting on a significant gain. So this is where understanding the market, timing your trade, knowing when to enter, when not to enter, what not to enter, all these things are become very, very important, right? So my view, or rather somebody who had done this, you could have either lost a lot of money if you bought here and you were holding, or if you bought here, lower here, and you were holding up here, you made a lot of money, right? Imagine somebody who bought here at 180, and this was when the market was here. The Nifty was at 9,750, and this was in October. This is almost 2.5 months. And bought it for 180 when Nifty was 9750. 9750 Nifty went all the way to 10,450 Nifty. That option contract went from 185 to 575, almost 400 rupees more. 400 rupees more was this rise. Basically 180, say 200 became 560, more than 2.5 times you made on this move. Right? And you have to really understand, I mean, what are we talking about when we say 2.5 times? You're talking about, say, 200 at a lot size of 75, you're talking about at least 15,000 rupees. That's the minimum that one can invest. 15,000 would have become about 40,000, 45,000. Okay, 40,000. Or well, if you bought multiple contracts, 1 lakh would have become 2 lakhs, 2 lakhs would have become 4 lakhs, 10 lakhs would have become 20 lakhs. The question is, how confident are you? How much capital do you have? Do you have that commitment? Do you have the conviction? Do you have the financial risk that you can take? Right. That is really the key. Right. Prakash is asking the question. Money is made even when prices drop. Yes, Prakash. Sorry, I missed the question. Yes, I was talking about this. Right. Somebody who sold it here, 560 rupee contract is now worth 180, and the person who sold it gets out. So let me put it in the insurance analogy. The insurance company takes premium when they sell the insurance. Suppose they sold the insurance for 560 rupees. So I am the policy holder. Prakash, you are the insurance company or the options company, in your words. You got my 560 rupees when the situation was like this, right? And now that the situation is like this, you come back to me and say, look, I took your 560 and this was the contract we had. I'm willing to sell this contract back, and I don't want this um, insurance. I don't want to give you insurance anymore, right? Now, I don't want to give you insurance anymore. I know you're the policy holder. So this is between you and me. Prakash is the policy company or the option company or the insurance company. Musa is the option holder. So Prakash option company comes to Musa policy holder, option holder, and says, I know we took 560 from you, but we are willing to give you back 200 rupees. Okay. And Musa accepts. Then has Prakash made money or not? Because Prakash got 560 but returned 200 and therefore kept 360. Now, in the so-called real world that most of us live in, this doesn't happen. So it's, for some of us it may sound like a fantasy, but in the real world that I live in, which is the financial markets, this is something which happens every day, every minute. It's routine, right? To the non-aware, the non-initiated, this looks like one fantasy world. But to those who've been in this, yes, to the question of can you make money when prices drop? Yes, absolutely. You can make money when prices drop, but almost always that is only something you can do in the financial markets, not in the so-called um, tangible markets. Let me put it that way. I should stop using the word real and unreal. Both these worlds are either real or unreal. It's not like one is real and the other one is unreal. For me, just the financial world is more real than this other world. I mean, the financial world seems to affect this so-called real world so profoundly, so deeply in many ways that we don't understand. I just take the financial phenomena far more seriously than the so-called tangible real world phenomena. That's just my view. Right. All right. So, uh, yeah. So, market moved up, you made money. Now, somebody who bought here, markets moved down, you lost money. Right. So, in terms of making profit and loss, it's like anything else. Right. What price did you buy? What price did you sell? That's all. That's all there is to it. It's never more complicated than that. Question is, did you buy it at the right price? Did you sell it at the right price such that you made a handsome profit? Right. So this is an example of the Nifty, right? We can take a different example of a different view on the Nifty, which is, let's say, 10,500. Okay, so that was 10,000. Now this is 10,500. Look at this. It's a similar but a pretty different chart. Yeah, first of all, the 10,000 one looked very much like this. This 10,500 looks quite different. And let's see if I can get another one. Wonderful. I don't know if there'll be any trading in this. See the 11,000. 11,000 has not gone up at all. If nothing, if anything, it just kept going down and down. Even though the market, went up here, you notice, even though the market went up here it was a very, very mild, piddly rise from about 2 rupees 60 paisa to 3 rupees 40 paisa. Hardly anything, right? Hardly anything uh, 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 worth talking about or going for or trading is not worth it, right? So this is again to show you that just buying any option or any insurance policy without understanding the ifs and buts and finer point can be injurious to your financial health at the very least. All right. Uh, One more thing. So there's one very key point that I want to demonstrate after this. Are there any questions here? I mean, so this was a move in which the last 2 days gave you a 66% return on the index. But the index itself, please note, did a 2% return. The index went from 10,050 to 10,250, basically a 2% return. But the option moved from 200 to 325, which is a good 50%, more than 50%, but 66% return. And this is in options. You can't again do this in futures, you can't do this in spot, you can't do any of this. The least investment required was 15,000 rupees plus brokerage, which is about 150, 200 rupees. And that 15,000, say 15,200 became 24,000 odd. So this is a real live trade that could have been done. And just like we were talking about Bharti, if the Nifty keeps going up, right, and especially so for those who know a little bit about the market, around 10,300, 10,400 is going to be some resistance. And if that breaks, then even 10,450 is entirely possible. If that happens, then this 10,000 call that we were looking at earlier, which is right now trading at around 320, could easily be 500 or even 600. So even what is around 300 could double, but the index would have gone up just another 2, 3, 4, 2, 3%. Okay, but this would have given you 100% return from current price. It is definitely possible. Any questions? Any doubts? Any thoughts? So, for all the stocks which are available in the derivative space in India, there are about 170 of them. Then you have the Nifty and the Bank Nifty, etc. Two indices. Right? You can do this sort of option trading. Any question? All okay? Okay, great. Okay, so what have we done so far? Just to very quickly review. One, I hope this is very clear, right? Let's review this. Options are just another financial product through which money is made or lost. However, options are very unique in the sense they have properties that no other financial product has. Is this clear now? I have not covered everything comprehensively, but some of the important key concepts. Are we clear about this? Okay. More like insurance, like than anything else. And the issue really is that most of us really don't understand insurance in the first place. So understanding options is a challenge. And I've only spoken one side of options. I haven't spoken about making money when prices fall, about margins, about all sorts of other things. We can talk about that later. Which makes them really special in many ways, not just about money, but a lot more. I have to talk about this, and that is more about data analytics. So just remind me in case it slips my mind. And this, I hope, is clear. When used well, efficiently, professionally, Okay, it requires a rewiring of one's understanding of finance and markets. So again, so far so good, right? For those of you who have traded options, well, this is what you've probably done, right? It's not done with a very deep grounded approach, right? But you have made money, yes. And extremely few participate in a significant and meaningful manner, right? And they put a large amount of money on the line. And what I really mean by this, folks, is in any of these examples that we have spoken of, I really, really want you to think about this, which is if you just found one or two or three opportunities like this, right? 200, 2x up, 4x up, 5x up, 60, 70% up in 2 days and all. And, you did it professionally, convincingly. And you did two, three, four, five trades like this in a month, right? I'm not talking about day trading, and I'm not talking about sitting in front of your screens all the day, but I am talking about doing something consistently, diligently, maybe spending, depending on how serious and active you are, maybe 1.5 hours per day. That's it. And on top of that, or rather, along with that, using some really good trading systems that are already available, right, at amazingly cheap prices, and learning how to use that, knowing how to put those orders, knowing when to get in at what price, when to get out at what price, and all that. And if you can get, I don't know, 50% on any trade, 200% on most trades, and a lot more actually. And if you can put a decent amount of money, see, putting 5,000 and then that becoming 30,000. I'm not saying you can't do this, but come on, to do this much, and of course you're going to make a 500% return, and you will make 25,000 rupees, which is not a small amount of money, right? But instead of this, or rather, if you're going to do this, instead of putting 5,000, if you put 50,000, and I know many of you here are capable of doing that, and 50,000 became 2.5 lakhs profit, 2.5 lakhs profit, and that was your only one trade you did the whole of the month. I think for a lot of us, it is amazing. It gives you what you need and much more in a month. And imagine rest of your month free, rest of your whole month free. Remember, this was identified in the first week of December. And this is just one opportunity like that. With the options universe, you'll get plenty like this if, if you're consistent, serious, committed, and professional. Right? So I'm just inviting you to take a look at what becomes possible for yourself in your life. For some of you, it might be just making lots of money. Well, okay, here is a method, a time tested, proper method, not casually, not as a hobby, not amateurish, but professional. And again, it doesn't mean you leave your jobs and do it, but it does mean you commit deep time and effort and energy to learn this well. Right? So for some of you, it's about making money. For some of you, it could be about freeing up a lot of time. For some of us, it is both. And for some of us, it is making a lot of money, freeing up a lot of time, and being able to do this from anywhere. Because what do you need? I mean, come on, we're doing a webinar. I don't know most of you guys today on the webinar, and I don't have any idea where you guys are on this planet. I know that some of you are just not even in Bangalore. That much I know. And even if you are, what difference does it make if they're in Bangalore or Bombay or Boston or Birmingham or wherever in this great earth? Computers, internet, power, and capital. Most importantly, knowledge, commitment, discipline, patience. All right. So yeah. So this is this is the market. Anything else before I just touch upon a few points to make you aware, and then we'll come to the end of the introduction. Is there anything you would like to ask? Questions? Anything? Anyone? Okay, so let me move on. If there's anything, you can put it in the chat box. Now, here's something for you to think about from this. One more point I want to uh, make as far as this option thing and it having some unique features is concerned. So going back to this chart, right? Now here are a couple of questions for you, or rather for all of us. All right. So just stay with me on the screen, and we're going to do some point-to-point comparisons. Right? We're going to do some point-to-point comparisons, and I'm going to ask you some questions on that. Shouldn't take just a few minutes. Okay. Yeah. All right. So the most obvious one. Uh, what's the Nifty here? Anyone? How much is the Nifty here? Value here? It's 9,750. Correct? 9,750 is the Nifty value here. The option that we're looking at here is at 170 rupees. Nifty 9,750. Option is at 150, 170 rupees. Right? Around 200. Now, the same option is at the same price here, but at a different point in time. So here it is around 200. Here also it is around 200. You notice this, right? But in terms of where the Nifty is, here the Nifty was 9,750, but here the Nifty is 10,100. Almost 300 points higher. Nifty is 300 points higher, but the option is the same price or similar price. How come? 300 points higher, but the option is at a similar price. Let's take one more example. Here, the Nifty is at 10,150. Okay, Nifty is at 10,150. Here also Nifty is at 10,150. Here also it is at 10,150, or basically this yellow line. 10,150, 10,150, 10,150, 10,150. Right, now if I put a similar yellow line here, right, 10,150, you can see that the prices actually for the option don't behave the same way. Here the option was 400. Here also it was around 400, 410. Here also it was at 410. But here, when the market is at 10,150 and actually much higher, it is at 330. It is at 330, right? Interestingly, notice this. Nifty here was 10,150. Here Nifty is at 10,400. Nifty is at 10,150, 10,400. So almost 300 points higher. But the option here, 400 to 460, doesn't seem to correspond in terms of this move. This move on the left side, 300 points up. Here this move, well, only 30-40 points up, right? So this is just for you to observe, right? Some things for you to think about, and that's one important thing here, or one key or unique aspect of options which is not at all there in any of the other financial products, which is time decay, as Ganesh has correctly mentioned. Time decay is a concept that applies to insurance policies, it applies to options. And the basic idea is, as time, as the market, as more and more time goes, the amount of time left for the event to happen is less. So you took an insurance policy which was for 1 year, 3 months gone, that event has only 9 months left to happen. 6 months gone, only 6 months left for that event to happen. 9 months gone, only 3 months left for that event to happen. Right? and that has a consequence on the cost of the or the price of that option, that which is called premium. And as that changes, then you get this changes in the price, and that has a very important aspect, a very profound impact on price, and whether you will end up making money or not. Okay, whether you'll end up making money or not. All right, so that's one thing for you to note. Let's also introduce the whole idea of making, not introduce, it's already mentioned, but practicalize, if I can make that word. Okay, show you a practical example of making money when prices fall through options. Right now, I know some of you already know you can do that through futures, but that's a different thing. Godwin is asking, are there formulas or methods to calculate time decay? Yes, they are. For the retail investor, yes, they are. And then we are getting into really complex issues there, because it's not just time decay, it's things like volatility, it is things like strike price, it is things like what type of option, is it a call or a put, which will all have to be considered in that formula. And that's something called option Greeks, which is a whole very interesting, very fascinating uh, approach to um, the markets, or rather to options. And that's something called option Greeks, like I said, and that is something, or it's one of the core topics which is covered in the options module of the derivatives course at BIC, right? So you're talking about you know time value, time decay, expiration, etc., and this whole thing, delta, gamma, theta, vega, all in detail. We'll do that in the course, right? More on that later, but to answer your question, yes, there are methods. Prakash, you're asking futures, have not understood. Yeah, I mean, that's a whole different concept. Today's session is only on options. Futures is a very different product. We had a separate session on that. Maybe we can have an offline discussion on that. Right? Okay. So, Godwin, your question answered about formulas, method to calculate, and there are simple and complicated methods, ways to do that. You know, this is one of those things which is very, very, very amenable to computerization and automation. And well, on the webinar, you guys know who you are. You guys are amazingly well placed to do automated option analysis. You get automated option analysis tools also, right? But it requires a whole different level of knowledge and skill to use them efficiently. But more than that, I can definitely tell you that all these option analysis tools which are available for the retail investor are something which are rather expensive, and if cheap, they're cumbersome and don't really have the features that we really, really need. So that still leaves a huge scope and opportunity for those who have coding skills to use them extremely profitably. I can only say one thing, and I don't want to say more than that on this session, that your coding skills that you're using in your jobs to make an X amount, please bring a fraction of those coding skills to the markets and you'll make 10x. I'm not exaggerating. Absolutely not. Right? And use a fraction of your time. So again, I keep saying this. Those who are interested, get in touch with me offline on this, and we can have a conversation and build those tools if we are serious and committed. It'll take time, but as you know, I think it's entirely worth it. All right. Yes. So, okay. Any other questions? All right. So let me now show you something else, not rather something else. Just use this and talk about when markets move down. So I've just zoomed out, and I want to focus on this part and this part. Okay. Here, markets have moved down, right? Uh, Markets have moved down. And could you have made money when the market moved down? So one of the ways to make money when markets move down is to short futures. And for those of you who don't know, just let's leave it at that. That's a whole different discussion. Shorting is a whole different discussion. Futures is a whole different discussion, etc. I just want to stick to options for the purpose of the session, and I will show you an option. And this time I'm going to make it a put option. So please note what I'm changing. What was here earlier was call. I'm now saying put, right? A put option, here it is, okay? And this is synced for time, okay? So the left chart and the right chart both have the same x-axis, right? You can notice on the x-axis they are synced in time. But what do you notice? Please notice this. When the market goes down, when the Nifty went down like this, okay, from 10,470 to 10,150, all right, here at that time this happened. This part of the down move is this part of the up move for this option. This up move for this option, which is a put option. A put option goes up when the stock price or the underlying price goes down. That moved from 50 rupees all the way to 100 rupees. From 50 rupees to 100 rupees. When the market moved down, when the Nifty moved down from 10,450 to 10,200, that means it lost 250 points, about 2.5% was the down move. The option moved up 100% from 50 to 100. The option moved from 50 to 100. The index moved down 2.5%, but the option moved up 100%. 50 rupees, right, into 75. Let's put 50 rupees. You would have invested 3,750. It became 7,500. Okay, so 3,750 became 7,500. You doubled your money, and I'm not joking when I say if you had put 50,000 rupees, it would have become 1 lakh rupees. If you had put 1 lakh rupees, it would have become 2 lakh rupees. If you had put 10 lakh rupees, it would have become 20 lakh rupees. And if that was the only trade you did for the whole week, for the whole month, maybe for the whole year, and you put 10 lakhs. By the way, there are people, don't, I'm not joking. There are people who have that sort of money. There are people who have that sort of risk appetite. There are people who are professional at that level, competent at that level, experienced at that level, who do this, right? Let me give you a better example. Here, the Nifty went down from 10,400 to 10,100. Okay, from about 10,380 to 10,100, right? So about a 3%, 2.5 again, right? 300 point move. Yes, 300 point move, about a 3% move. At that time, this option moved from 40 rupees to 100, went all the way to 115 rupees. Okay, 40 rupees to 100, 110 rupees. More than doubled. More than doubled. So, of course, at the very least, if you say 40 rupees, then you're talking about a minimum investment of 3,000 rupees. At 110, that became 8,000. But you know what? I'm serious. When I really say, I really sometimes feel I could just shake everybody by their shoulders and make them really see what is possible. And I'm saying doing all this professionally. I'm not saying casually. If you could have done this and you could have identified the bounce, and if you could not identified the bounce, identified the fall. And by the way, falls happen much faster than rises. If you could have identified this fall, right, or this fall, right, and this is the whole, when this change, that change. So first of all, notice while this whole index has gone up, this option has gone down. Okay, but when this has gone down, here, last part, this has sort of bottomed down and gone up. And I'm not overlaying it here, but this up move here, the sharp up move on this option where it went from 200 to 340 was because of this down move here. Okay, I'll just leave this for a moment for you to just scan and use your eyes and pay attention. When this down move happened, this up move happened. When this down move happened, when this moved from 10,150, 10,160 all the way to 9,700, about 800, 900 point fall happened. Then this up move from 140 to 320 happened. Okay, this fall, this up move. When this up move happened, then this option fell. This option fell all the way from 320 to 50, 60 rupees. If you bought here, you lost a lot of money. But if you sold here and then you bought it back, then you made a lot of money. Right? It's really depending on what you did. You did the right thing at the right time. That's what you have to really think about. Okay. So I wanted to just show this to show that money can be made through options much better, much more efficiently, much faster with actually, a lot of people think option trading is high risk, but believe me, option trading is low risk stuff, right? I'll speak about that in a minute. Just remind me. So I just wanted to demonstrate how money is made when prices fall, and there are different methods and different ways to make money when prices fall, and especially for Prakash, who was asking this, might be totally new. Well, there is your evidence. For others, I know some of you are already very familiar with this idea. For some others, this is a very new concept about making money when prices fall. All right, there you go. Lots of opportunities, and each one was more than 100 to 100% minimum. Some of it 200% moves, right? And that is when prices fell. So when prices fall here, right, that is when prices rise here. It's inverse, but not proportional. It is inverse, but not proportional. All right. So, any questions on this part? All right. So, yeah. Any thoughts? Prakash is asking options low risk. Yes, actually. Even though this might sound really, really crazy to say you can lose all your money, but at the same time say low risk. Yes. So I think for this Prakash, there's been a lot of new revelations in the last few sessions he's attended. And how can something where you can lose all your money be low risk? Must be one question that's like going around. So see, Godwin had a question. Godwin says he always read that options are high risk. Yeah. A lot of stuff that you read on the websites are low risk, high return products, right? That's typically the logic that is talked about in the public domain, that options are low risk, high risk and high return. Well, my view is very, very different. And I'm happy to have a separate session on this to go into the details of it. But options are really low risk, high return products, right? It is a stupidity to do anything which is high risk, right? You might do it once, right? Let me, give the example of driving a car really fast. When a Formula One driver drives on the racetrack, right? When a Formula One driver drives on the racetrack, okay. Uh, or let's rewind a bit. You drive, let's say, a Maruti or a Toyota or whatever you drive, and then you say, let's hit the F1 racetrack, and let me just take my ordinary car, which is that Maruti or Toyota, and let me just go as fast as I can because I have the F1 racetrack, no traffic, nothing. It's an open road just for you. Nobody else is on that road. And with your level of skill that you normally have driving on normal roads that a normal person drives on, what do you think will happen to you if you were to take your normal car and drive it on F1 racetrack at the highest speed you can? What do you think will happen to you? Godwin says kaboom. Yeah, exactly. Probably on the first corner itself, even though you have 100 feet wide road with a very gradual taper and turn, you're going to lose control. And that's it. That's the end of the car, probably. Maybe the end of you. Right? Now, let's take the other extreme. Okay, let's take it one step. Now you say, okay, you know what, the car is not so good. What the hell? I want an F1 car, but you're the normal driver, okay, the normal lay driver. And we give you the F1 car, take whatever, the McLaren F1, the Mercedes F1, the Ferrari F1, and go drive it. They say, okay, here's a $5 million car. It's got all the gizmos you need, ultra slick tires, ultra low center of gravity, it's all tuned for you. First drive, take it, drive it, do the round as fast as you can. What do you think is going to happen to you? Godwin says bigger kaboom. That's true. Right? Exactly. I've never sat in one F1 car, but you know what? I'll invite you all to do something. Please Google up for how many people who take their delivery of a high-end McLaren or a Ferrari or a Lamborghini or even a BMW or a Mercedes Benz, because you can't do this in India, but you can do this in Europe, you can do this in US, etc. If you want to take delivery of your brand new supercar, you can you can go to the factory and take delivery, and that's the first time you get into that car, and you before that you were driving a Toyota or a Maruti. Please Google for how many people who drive a Ferrari or a McLaren or anything for the first time, okay, for the first time, end up in an accident. Please Google it up, right? You'll be surprised, right? And Godwin has a suggestion on the chat, and he's saying, everyone try riding a go kart. Just go to any go kart place, just 20 to 40 horsepower, and drive it as fast as you can, and see how it is. Okay, I have done that actually, and it's a thank you, Godwin, for suggesting that. Any of you have ridden a go kart? Any of you? You have plenty of them available everywhere nowadays. So if you have not, please, so Sunday we'll finish the session soon. I hope, and please go off and just do one round in a go kart, ordinary standard go kart. Everybody goes in one direction. They give you a helmet, ultra safe. Don't worry about it, and do it. It is really tiring. It is damn tough to control. Okay, not tough to control as it's not controllable, but when you drive fast, the fitness you need, the ability to control that you need, the braking, the coordination, all that, everything is whizzing past so fast, right? You drive a go kart at 40 kilometers per hour, it looks much faster than driving a Maruti or a Toyota at 120 kilometers per hour. I tell you that it's the wind in the air, sitting so low on the ground, seeing the tar right centimeters away from your foot, and all that rush of a feeling. But coming back to the F1, right? So they give you the F1, you go drive, and well, now let's take the F1 professional driver, for example. What do you think that guy is doing, right? That guy sitting in that F1 car, do you think he's taking high risk or low risk when he's driving that car at 300 kilometers per hour on that F1 track? If you do it, are you taking high risk or low risk? And if he does it, the professional F1 driver, is he taking high risk or low risk? Same car, same track. Anyone? Right? It's taking that example for anything which is extremely high skill and precise, right? Um, for anything which requires a high level of skill and competence, etc., then training, experience, fitness, all that, yeah, Godwin has mentioned that, right, is true, right? We have a pilot on the session. Is he still there? Nah, he's left, right? Um, you go try flying a plane, just a normal plane, either a Cessna or a Boeing, doesn't matter. You know, for a professional, it's a normal day by virtue of his training, by virtue of his experience, by virtue of his gut feel, intuition that he has built. But for anybody who is not in that place in a competent manner, it is very high risk. For that F1 driver, it is a very low risk event to drive at 320 kilometers per hour. But for you, even if you are a passenger in that F1 car, you would need diapers, adult diapers, right? That's how it is. No amount of assurance that okay, you'll be fine, nothing will happen, don't worry. You are going to still be scared. You drive with the top driver, just sit, don't do anything. He will do all the driving, but you're not going to be sitting there calmly and saying, "Oh, okay." Right? So what I'm getting down to is this: in anything which you do, where anything is at where the returns are very high, in whichever way you define return, whether it is monetary return, profits, trading options, or you talk about driving an F1 car, or you talk about running maybe a technology company, or you talk about um, growing some really exotic cash crop, uh, uh, or doing some high fashion. I don't care, right? If you are doing it without skill, if you're doing it without knowledge, if you're doing it without competency, if you're doing it without experience, then you are doing something which is high risk. All right, no matter what the returns are. How does one make something which is high risk, low risk? And that happens from training, from exercise, from fitness, from discipline, from knowledge, from having the right tools, etc. If it was, so when you say in the websites that option trading is high risk and high return, it is absolutely true for the amateur guy, for the public, for the masses. It is absolutely true. I mean, if you're going to have these sort of returns where you buy something for 400, 500, 300, it goes to 60 rupees, and it'll go to zero also, by the way. Of course it is very high risk. But if you know when to get in and when to get out, and you're doing that on the basis of knowledge, then how is it high risk? Can you not do it with competence? That's my whole point, right? So you can do a lot, right, at your end to go from a situation of being in a high risk thing by default to transitioning to a very, very low risk thing with competence, skill, experience, and time. The question is, are you willing to walk that road? That is the question for you. That is not the question for the markets. And then suddenly when you get there, right, it really becomes low risk and high return. In my world, options is low risk and high return when it is done with all the stuff that we have discussed and much more. Yeah, Prakash has said it very well. A credit card in the hand of a school kid, definitely high risk, extremely high risk, right? But credit card in the hands of a very astute person would be the best thing that he ever has, free money. If you are, let us say, one of those, ultra HNIs, and they gave you this 2-month credit cards, 2-month credits, this premier Amex cards and all of that, which most of us will never have access to. And you can go swipe for 500,000, 1 million rupees, okay, 10,000, 20,000, $50,000. And then, the only thing is you can't settle in parts. You have to pay it immediately or at the end of the month. So what? Yeah. If I'm always having an outstanding of, say, $100,000 or 100,000 rupees, okay, which I promptly pay off at the end of every month somehow, okay, and then again max out the card. Basically, it means I am having $100,000 with me for life every month, except that every month I'm paying it up, and the very next day I go and max out my card. There are people who do that. It's like getting a 0% interest loan to the maximum limit of your card. Just pay it before the due date. That's it. The credit card company will hate you. Okay, they will hate you, right? Because they're not making any money off you. But imagine what sort of liquidity becomes available. And if you are smart and if you've used that money for something good, then imagine being an ultra HNI who's got $1 million credit, right? Who's got $1 million credit and paying nothing to get that $1 million, right? Yes, Prakash. I mean, thank you. That's the sort of stuff that we want to be in. That's the sort of stuff we want to teach our children about, right? How to be really smart and how to be really astute. Well, before that, we've got to get smart. We've got to get astute, and then take it from there. All right. So low risk for the professional, high risk for the masses, and that's always how it is for everything. Cardiac surgery, even ordinary appendix surgery, high risk for the newbie, low risk for the surgeon with 5 years of experience and already having extracted 100 appendices. It's that's how it is. So if you're going to get scared with options or overwhelmed and say because it's high risk, that's because you or me or whoever did not put in the time, energy, effort required to make it low risk for ourselves. It will not become low risk on its own. The Formula One car has no mind of its own. The F1 track has no mind of its own. The option does not have any mind of its own. It's you. You are the driver of your, if I may say so, your reality. Which direction are you going to drive? Are we putting conscious effort towards what is good, or are we okay with being casual and mediocre? That, I think, is the question, especially when it comes to options. Right? Okay. So I hope figuratively at least the question about options being low risk got answered. Are there any questions on that? I'd be happy to take that because I think it's an important thing. Any questions? All right, great. So I actually must thank you really. I mean, we are going over time. I thought we just do this for about an hour and a half or two. There's one more point I'd like to just, spend a few minutes on and then close the session. But if there are any questions, let me know. Which is, this data analytics, right? Are there dummy practice trades? Yeah, there are dummy practice trades you can do. I mean, this is for all practical purposes, dummy practice trades. You could, look at. Mm, it really is a question of following it up and knowing what can happen, what can't happen. So if I go back and make this the call option, then there is your dummy practice trade to track. Okay, right now it is there at 330 rupees, the 10,000 December call, and see what happens. You can do the same thing for that Bharti 500 or 520. So let me combine these two questions, or two things about dummy practice trades and data analytics, right? And yeah, so going back to the NSE website, that is where almost all the option trading happens in India, National Stock Exchange. Right? So let me just give you some stuff for you to follow up on in the coming days and weeks, and who knows, years of your life. If you go to the main website nseindia.com and then you click on live markets, you will get on live data, okay, which obviously, since it's a Sunday right now, you're not having any live data. Then click equity derivatives. You have clicked that, and what you get is this chart, which by default starts with the Nifty index options, right? So this is what is called an option chain, and it gives you all the option contracts available for the Nifty. You can also search for underlying stock, for example, Bharti. Right? If I put Bharti, it will show me a window. I want Bharti Airtel, not any of the other Bhartis. So I've clicked Bharti Airtel. Now this is the option chain for Bharti, and you know what you're looking at by looking at this, right? So you can look at options of individual indices, or you can look at for many of the stocks which are there. So just keep it simple for yourself. Track the Nifty, track the bank Nifty. So you can select that from here. A lot of these are not liquid. What is worth tracking is only the Nifty and the bank Nifty options. And then there are 170 individual stocks that you can track options on, the popular ones, whatever comes to your mind, like Reliance Industries, L&T, Maruti, State Bank of India, HDFC Bank, Cipla, Sun Pharma, all these things. Just put those names. If they're there, it will come up, right? So when you look at this, right, you open this, and let me just go back to Nifty. Right. You'll get this screen, and on this screen you have various data that are available, right? I'm not going to get into the details of this. I just want to leave it with two things. So there's all this, OIs. OI is called open interest. Then there's change of open interest, volume, and IV is intrinsic volume. Sorry, intrinsic value. No. Sorry, I'm confusing things. IV is implied volatility. Okay, don't ask me what all these things are. That's all in the course, not in the introductory session. Open interest, volume, intrinsic value, last traded price. That is what, Prakash, you want to be tracking. Then there is bid quantity, all that, strike price. Then on one side you have calls, the other side you have puts. Okay. Now if you look at all this, there's a lot of data here. You can keep scrolling. There's a lot of data here, right? And this data just changes live during market hours. Live, it's not live. It is actually, I think, 5 or 10 minutes delayed, but it keeps there. So if you keep doing F5 and keep refreshing, it will keep changing. It doesn't change on its own, but you can ask for a refresh. That's one. Second is, you have this data which is available to you as a CSV file at the end of the day, values for all these things, right? Now, by just looking at this data, not even analyzing, I'm saying looking at it and knowing what these numbers are, okay? Knowing what these numbers are, what is it that is this thing, OI and this, that. So you'll see something, it's 5.6 million, here it is only 1.8 million. On the other hand, here it is 4 million, here it is 8.6 million, etc. Just by looking at this data, you can get a much deeper insight into the mind of the market players. Do they think the market is going to go up? Do they think the market is going to go down? In which move, in which side of the market are they, more focused on? Are they buying the options? Are they selling the options? By tracking and analyzing this, you can get a sense of their view. If somebody is buying something, they expect the price to go up. If they are selling something, then they either expect the price to go down or they're getting out of the transaction. And then you can extrapolate back, and then there are these various permutations and combinations you can do to put all this data together and create a view of the market which is different from what is your view. And at the end of the day, remember, we are just small retail traders. If we can understand what the big guys are doing, if we can get a sense of what is likely to happen, then, and if we can get all the help we can get to develop that sort of a view, then would that not be nice? Okay. So even this thing that I showed you here, right, of Bharti, right? Now I showed you the chart of Bharti, which is great, right? But was Bharti going to go up or not? Okay, was Bharti going to move up sharply like this or not? Was Nifty going to go up from 10,000 levels, 10,100 level, 10,150 levels? There's only so much you can get from spot data and from futures data. But if I started analyzing this data, okay, then there is 10 times more insight you can get, and 10 times more confidence you will get, 10 times more, you know, conviction you will have to play the big game. I am really interested that all of us are looking at this not from 3,000 becoming 8,000, but 3 lakhs becoming 8 lakhs, 30 lakhs becoming 80 lakhs. I am not joking about this. All right. But the difference it takes for anybody in life to play the small game versus the big game is knowing you know what you're doing. And that only comes from knowledge and experience and commitment and all that sort of stuff. Right? It's what makes the professional from the amateur. It what separates the consistent winner from the gambler. Right? Who do you want to be? That is really the question. But coming back to the point here is this data analytics of the option data, and this all this is unique to the world of options. You will not get this sort of data in futures, you will not get this sort of data in spot, you will not get this data in chart analysis or technical analysis, and you will not get this data in fundamental analysis, right? This is a very different type and a different world of data and a very different insight on data and a very actionable data, right? Today the word data mining has been used left, right, and center, but it's mostly being abused. Data mining for many people has become how many GBs and TBs of data you have. It's useless. It is what can you do with the data that matters. Do you know what that data is? The data itself is not telling you anything. It is your ability to extract intelligence from that data and then get actionable insights in it that is the key here. And that is what data analytics can do. Data analytics can actually tell you, and I'm not joking and I'm not exaggerating. For anyone interested, have a separate offline conversation with me, right? Can give you a real time picture of this market turning, okay, of this move beginning to happen, right? Of this move being set up in the options thing. You can see it happening before the price moves. It's like reading the mind of the market. It's like before the Bharti Airtel even moved to 990, 490, 495, just by tracking options data, not price data. Okay, I'm really emphasizing this. I'm talking about option data analysis, live option data analysis in this example. Okay, you could have seen this rise coming before the price actually went up. Now, and similarly, okay, similarly, if I take the Nifty example again, the same similar type of data analysis of Nifty options could have told you about this price going down. It could have told you about this price going down. It could have told you about this price stopping to go down. It could have told you about this price going up. It could have told you about this price topping out. Now, I'm not saying it will happen all the time. I'm not saying it is perfect, but I'm telling you that it will give you much more insight than what you have right now. The question is, are you willing to go down the road? The data is there. This bounce that happened, you could have seen it happen on options data if you were tracking it. Now you can do this live if you want, or you can do it end of day if you want, whatever you want to do. The question is, are you willing to learn all those concepts? Are you really willing to go deep down and do that sort of work that you need to do, right? I won't spend too much time talking about the course. If you're interested, get in touch with me. But all this and more is covered in the options module of DIC's derivatives course. So we've completed the futures module, right? In case any of you missed it, you have access to it through the flipped classroom approach, which is you watch the recording and then you have an interaction to clarify any doubts with me, right? You can also participate in the option thing if you want as a live session, which we will start probably next weekend. And it's going to be there, and it's going to be an ongoing process and available. Question is, how far are you willing to go down? How professional do you want to be, right? And so I just wanted to initiate the thought about data analytics and tell you what is real possible with it. If you look at how the institutions do data analytics, some of you are going to be really blown out of your mind. The sort of stuff those guys are doing, and they've been doing this for 10, 20 years, right? And the sort of edge, the sort of advantage that they have, even without real-time data, even 5-10 minute delayed data, and the sort of insights that you can get is just amazing. It's a crystal ball. I'm not kidding. You can actually see moves happening, right? But that's a whole different world. And I'm spending a little bit more time, and I'm getting a little bit excited about this because I know that on the webinar right now there are people who can address that problem with their left hand little finger. It's so easy for them. Whether they want to do it, well, that's really up to them, right? And I'm happy to collaborate. So coming back to Prakash's question about dummy trades. Well, you know what you should do, Prakash? Well, this is what you should do. You should just go look at the same screen on the NSE, right? And this is the LTP is what the price is of that contract, right? So each one, this is one contract, right? On the left side is one contract, on the other side, on the right side is a different contract, right? Now, let's not get into the technicalities of this. What I would just suggest to you, Prakash, is just track these prices. You see them right in the, here, these prices. This is what you need to track. You can track them live, just have the screen open at your end, and when every few minutes or every few hours or whatever you feel like, press F5, it'll refresh, and track these prices. Forget about the rest of the numbers. Forget about the rest of the numbers because for you it's probably very new. Just focus on these prices in gray. This one, this column, and this column. And do that just for Nifty. Just do that for Bharti, do it for Reliance, do it for whatever is your favorite stock, which is there in the derivative list, right? And just do this over the next few days and see what happens to these prices, right? And there'll be a multiplier which is different for different contracts. So for the Nifty, the multiplier is 40. It's 40 units of Nifty in every lot. For Bharti, it is 1,700. Just tell me which stock you're looking at. I'll be happy to get back to you on the lot sizes stuff and support you there. Just track this and just keep a track on this pencil or an Excel sheet, pencil and paper Excel sheet, that if you had bought it at this price, sold it at this price, and all that, then what would have happened, right? I hope that answers the question. But really, the whole thing is this, and this is the final thing that I think I have to say with options, is that see, at the end of the day, please remember this, right? Options are a tool, right? Are a tool that lets you take a position in the markets. Now, there are different tools. You can do that with options, you can do it with futures, you can do it with stock market, you can do it with spot markets, or you can do it with mutual funds, right? All of these are different tools. The objective of all the tools is to make money, right? Is to create a profit. But how they do it is very, 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 very different. The risk profile, the return profile is different. The knowledge base required is different. The competency required is different. The sort of trading that you don't do is different, right? And these are higher degrees of skill, competence, and products, right? Now, it's the same thing as saying you have Padmini ambassador from the good old 1960s and 70s. Then you had the Maruti 1980s. Then you had the Toyotas in the 1990s. Then you had the Mercs and the Audis and the BMWs in the 2000s. And now you're getting Lamborghinis and Ferraris and all of that. And you can buy a McLaren also, not a problem. Question is, do I first even know how to drive the car? Right? So I can drive any of these, and each of these will require a different degree of skill, a different degree of knowledge, a different degree of competence, a different degree of experience. There is no way you can drive. Maybe you can drive a Mercedes Benz, even that the lower end ones, just like you drive a Toyota or a Maruti. But the higher end ones with all this automation and gadgets and all of that, they require a different mindset, a different skill, right? And then if you're driving some of the supercars, you better go for training, serious training, before you put your foot on that pedal there in that car, right? So point, however, is that uh, uh, what do you say? Knowing where to go, is that clear, right? So this is where you have to marry technology, sorry, the product with knowing where what you want. And knowing what you want is analysis. Do you know in which direction the market is going? Is it going to go up or is it going to go down? You need a map of the market first, and then you need a tool to navigate that direction. So you have to know, is the market going up, down, sideways? You have to either do technical or fundamental or some sort of analysis that tells you in which direction the map is, the price direction is. Then you say, which product will I use to implement that view, right? Which product will I use to implement the view that the price is going up? Are you going to do that in the spot market, futures market, or options market, right? And then if you're doing it in the futures and options market, which type of contract will you use? All those technicalities start to happen. If you expect the market to go down, then how are you going to implement that view, right? So don't confuse direction, which comes from analysis, price direction, which comes from analysis, and the tool that you use to execute that view. Are we clear on this, right? Because it's a very, very important thing to understand and know, right? Knowing the direction of the market is paramount. You do that first. Then you decide what tool to use to execute that direction, right? So you have to um, you know, learn the analysis first and then discuss the tool. Generally, however, I think especially in the financial markets, we discuss the tool, but we don't know what they are. It's like literally like going to the operation theater, but not having done any investigations at what's wrong with the patient. It's crazy, right? It's like sitting in the car and saying, okay, now let me think, where do I want to go? Most people get into the car only after knowing where they want to go. Here it's like, let me sit in the car and decide. It's like going to the airport and saying, going to the counter and saying, okay, just give me some ticket to some place, right? So analytics, analysis of the market, and then which tool are you going to use to execute? And those two have to come together. Any questions? All right. So thank you so much for staying so long. Uh, I know I've eaten into your lunchtime, quite figuratively. Uh, I do wish you have a great lunch after this. Food for thought, food for what your future could be. And I hope it was a really good session. I would love to have your feedback. I would love to have your inputs. Give a call. I would definitely, have a couple of requests to make. Thinking of getting a little bit active on various things. So please go to, Facebook and to BIC's homepage there. So we have a, where is that? Right? Just go to Facebook, BIC. Hope you can like us, right? And also, I would really appreciate it if you feel it's deserved to write a personal review about BIC on the Facebook page. And please, if you could also, do that through Google, right? When you do a Google search for, sorry, right? When you do a Google search for Bangalore Investors Club, you'll get Bangalore Investors Club, and it would be great if you could write a review there. The reason I'm asking is that I've woken up to the power of social media very very late in life and very very late in the technology, but I really want that we can impact more people. I don't know, something has just shifted for me this year in 2017, that I really, really wish more people to, take part in the opportunity. And I'm trying to do something with my own skills and competence into growing that community, into taking this work out and I really mean this, I really hope we can just, there's no agenda. Yes, sure, of course, if people come through the classes, I'm going to make money and all that stuff, of course, is there. But what really is driving it is a desire to impact more lives, a desire to impact more people, to get them to know about what is possible in the markets. And, I'd love to have all your support for that. And anything in any way that you can help, please do let me know, and I'd be happy to talk to you. But to start with, like on Facebook, a review on Facebook, and a review on Google reviews would be great, right? Uh, yes, so that's it. Thank you very much. Anyone who's interested in the course itself, please do get in touch, right? It's probably the last live FNO course that I'm going to have. After that, it'll be the flipped classroom mode. So if you'd like to join, please visit Bangalore Investors Club and the derivatives homepage there, and all the details about the contents, the fees, the schedule, everything will be there. And of course, if you need to get in touch with me, then you know how to do that. That's my number. Give me a call, and if I don't take your call, I'll definitely call you back. And I love to have one-on-ones, so do come over, or let's meet up for coffee and tea. Right? Thank you. Have a great Sunday, and hope to catch up with you soon. Bye.